What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Nasdaq cannot get a break, down another 0.4% on equity futures this morning. The S&P 500 negative about a tenth. If you look at the S&P and the Nasdaq over the last week, a week of losses, but the Nasdaq 100, the underperformance, absolutely brutal, down 4.5% last week. We take some more weight off that index and take another bite out of the gains of last year. If we switch up the board and get to the bond market last week for that 10-year yield, just wow, 25 basis points higher in a single week. 10's right now 176.92, yields higher for a 7th straight session, up another basis point. All the talk about the Fed rate hike calls from the likes of Goldman, 4 hikes from them, and Deutsche Bank, and Citi, and JP Morgan. They all think we're going to kick things off in March. What's interesting for me, though, right now, Tom, is this conversation about balance sheet reduction, the start of so-called QT, not in place of a quarterly rate hike at Goldman Sachs. There was some discussion that maybe that announcement, Tom, would replace a call for a rate hike at that particular meeting. No more for Jan Hatzius.
Well, the gyrations are there, and we've all pulled it forward, John. I get the overlay of the balance sheet dynamics and the rate dynamics as well, but I would overlay that, John, with a possibility we get better economic growth along with a more persistent higher inflation that's unacceptable to all. And John, to me, that's the mystery of, say, July and August of this year.
The second half, Tom. I think for many people, the hope is that the growth keeps delivering. The fear is that it fades in the back half of this year. That was something Laurie Calvasino of RBC was talking about this morning. Maybe it start with the cyclicals this year for the equity market. That's where the performance is. Then maybe in the back half, it's back towards the growth story. We'll get into that later. I want to look at the chart, though, Tom, over the last year or so for the 10-year yield. That 25 basis point move to 177 right now. 177 was the higher last year. This morning, we breached 180. We went through 180, TK, for the first time, I think, since going all the way back to 2020. So we've taken out the 21 high, and we're going back to highs we haven't seen since early 2020.
We are then, the market's moving again. We'll watch that. I mean, I look at the benchmark 30-year bond, folks, 2.13%. I also look at the German 10-year yield to see that go positive would be of interest as well. It is January. It is a time of resolutions. It is January, and you need to do something now, so just possibly you'll be smarter 12 months from now. What's interesting is the shortest answer that I know, and I've trumpeted this for years, is a physical subscription to Foreign Affairs magazine. On radio, it's simple. You throw it on your table, you read 1 or 2 articles every month, and you are way better off. This month is no different. The Digital Disorder, a tour de force, including Joseph Nye, Vali Nasser, and Elizabeth Economy. Dan Kurtz-Phelan joins us right now, editor of Foreign Affairs magazine. I went right to the Elizabeth Economy article, Dan. She did some great work with us with Ian Bremmer a few weeks ago. She parses China in America and says maybe China's looking at the battle, and they may win the battle, but will they win the war? Piece that out for us now, the battle and the war in Beijing.
That's right. So, Tom, as you know, Liz was really one of the first people to remind all of us and to really point out just how ambitious Xi Jinping was when it came to his what he wanted to do within China, what he wanted to do globally. So Liz was really on the ambition of Xi Jinping, the extent to which he really represented a change in Chinese leadership. And what she sees now is just the truly global extent of what he's trying to do. And you see it in Belt and Road, you see it in China's ambitions in its own region, in Taiwan and the South China Sea, some of the crises we could see coming this year. You see it in its economic role globally. And what Liz really traces out in this piece is the tension between Xi Jinping's leadership style and the extent of those ambitions. So you see, we all spend a lot of time reacting to some of the, gigantic top line investment numbers, to some of the ambitions. But Xi Jinping, as we're starting to see, also faces a lot of real challenges, and he may be his own worst enemy when it comes to some of this. And one of the really worrying things, I think, at this particular moment, especially as you have Xi Jinping having not left China in a couple of years, it's unclear what kind of information he's getting, what kind of feedback he gets. So you see this gap between ambition and ability to deliver that could manifest in slightly worrying ways in the months ahead.
You are an expert, Dan Kurzfalen, on another time and place of China's fractious relationship with America, and that's George Marshall after World War II. Who's Joe Biden's George Marshall? You know, there's that scene where Marshall retires, and FDR calls him up like 46 hours later and says, unretire now, you're going to China. Who is the George Marshall for the president to get this done?
I think what you see that is similar between that time and now is really this fight within the administration to define the basic objectives of what we're trying to do with our China policy. So in the 1940s, it was this question of what you do to try to stop Mao from coming to power, stopping a Chinese victory, which is something, as we all know now, we failed to do. And there's a similar fight today among different parts of the administration, different parts of the government, to decide just how tough we need to be and to what extent we can be conciliatory. So you have, someone like John Kerry trying to find ways to work with China on climate change, and you have others within the administration at the Pentagon, Kirk Campbell at the White House, I think are trying to craft a tougher line. And it's really this process of working out how these different forces fit together within the administration. So you can see some slightly incoherent elements to this over the course of this year. And I think the challenge for the administration going through this year is trying to really craft that into a strategy that reflects those various considerations and pressures, and the president himself is behind.
There's so many incredibly important topics. I do want to stay on China, but I do also want to address another essay that I thought was fascinating about the rocky transition to green energy, especially in light of what we've seen in the price of oil, the surprise rise because of a lack of supply, a lack of investment in production. How does the global revolution in green energy rejigger the global powers?
So this is a great piece called Green Upheaval by Megan O'Sullivan and Jason Bordoff. And what really comes through in this is that even as we start to think about new energy sources and look towards a different energy future, the geopolitics don't go away. And that's true both in the medium term and also in the long term when you do see a truly green transition. So in the short term, there's no better example of this than what's happening now with Russia and Ukraine and Europe, where in the short term, Russia has more influence from its energy resources, and that's a big tool that it brings to the Ukraine crisis. And then in the long run, when you look at things like rare earth materials and the kinds of inputs to all the parts of the green supply chain, all of that's going to become geopolitically complicated just in the way that oil has been traditionally. So even as you consider a very different energy future, a lot of the dynamics and risks that are very familiar to us from past decades are not going to go away. And in fact, in the short term, they may go up, especially if policymakers don't really appreciate those risks in the near term.
Well, I was just thinking also about Kazakhstan, for example, and the uranium output, that they're basically the Saudi Arabia of uranium, and people are suddenly aware of this because of its input to nuclear energy. Who are going to be the powers of the green future that you foresee, even with some of the rockiness along the way?
So this, to go back to China, China has been very, very deliberate, as you all know, in building up its power here. And I think before most other governments were really thinking in these terms, China saw that by becoming the green energy superpower. It's obviously still using a lot of coal and using plenty of dirty energy, but it really set about trying to dominate the supply chain and dominate a lot of these industries that subsidize these industries really heavily. But then you also have a lot of much more kind of complicated geopolitical spaces where mining is really prevalent. So you have the DRC, the Congo, where there are important mines. You have places like Chile and Bolivia. All of these bring their own foreign policy questions. So there was obviously a time when we would have worried about securing oil supplies in the Middle East, but now it's going to be this major foreign policy consideration, thinking about those materials that are in, again, some complicated countries that are going to bring political challenges of their own.
Dan, thank you. Dan Kurzfalen there of Foreign Affairs. Tom, what a start for geopolitics in 22. It's not just the markets, it's the tension between the US and Russia, which is going to be a key feature of talks this week.
And get out the map, John. I mean, just the triangulation over the weekend. I mean, by no means am I an expert on this. I wouldn't know it if it hit me over the head. But to go from Minsk to Kiev and then out to Kazakhstan, I mean, John, it's almost like Peter the Great era. It's like borders, multi-fronts for Mr. Putin.
Well, Tom, you're right to get out the map, because if you get out the map and look at how long the border is between Russia and Kazakhstan,
It's ginormous.
you've got an idea as to why
Yeah.
Russia cares so much about what is happening right there, right now.
Yeah, I just think it's front and center. And, you know, am I focused on it? Do I think it matters for the markets or what we talk about every day on surveillance? No, but, you know, John, it's the kind of thing where it's contained and it's in control, and then suddenly.
Until it's not.
Until it's not. And it's that whole suddenly thing. John, I'm fascinated your thoughts on the United Kingdom and China, and particularly almost year 2 of what we're dealing with Hong Kong. I don't have a clue how that's going to play out.
Hey, Tom, it's just really sad. I mean, you and I have talked about this so many times. And I think on several issues now, when it comes to the Europeans, they're just fractured over how to deal with the Chinese Communist Party. And Germany finds itself at the epicenter of that every single time. What the Chinese Communist Party has been absolutely fantastic at over the last 20 years, Tom, is building out these commercial relationships with places like Germany. And those massive commercial relationships become these really, really sensitive weak spots in geopolitics. And I think Germany finds itself at the epicenter of that every single time, not just with the Chinese Communist Party, but with Russia as well.
We should point out it's a new Germany. It's a Germany that has to go up to the east with an Eastern Europe, which has some real turmoil. I mean, that's part of what Foreign Affairs magazine is looking at as well.
Yeah, and talking of the tensions between, say, the US and the Chinese Communist Party, Tom, you can find many, many companies and many, many leaders of those multinationals that are happy to criticize the administration here in America. They won't even speak of it when it comes to the Chinese Communist Party. You can't even get them on the record. Traditionally, we'd be in Davos, Switzerland, in about a couple of weeks.
I got my boots on today, John.
Just in tradition, hey, Tom. Look, we'd be sitting down with those CEOs and we'd be saying to them, tell us about China, tell us about the Chinese Communist Party. We'd have a very, very simple question. The administration now is accusing this government of genocide. Why are you operating there? Tom, they will shudder. You've seen it. We've both seen it. They won't even touch the conversation.
They don't want to talk to us.
They don't want to talk about it.
They don't want to talk to you. You're vicious and I'm worse.
Lisa's going to be even worse. When's it going to take place, Tom? June?
You know, what's great is the Tang here is better than at Motel 6.
Is that right, TK?
Yeah, that's good.
Yields unchanged on 10s, 176.74. Futures down 11, down 0.2%. From New York City, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. In Kazakhstan, security forces backed by Russian-led troops are restoring control after crushing demonstrations. The government says almost 6,000 people have been detained. According to state TV, 164 people were killed. The real number is thought to be much higher. Now, tennis star Novak Djokovic has won a court battle to stay in Australia and play in the Open. A judge reinstated his visa, which was cancelled after his arrival last week because officials decided he should not be exempt from vaccination requirements. The judge also ordered that Djokovic should be released from detention. Still, Australia's government is threatening to cancel Djokovic's visa for a second time. The parent of Facebook is going bigger in Texas. Meta Platforms is leasing half of what will be the biggest skyscraper in the city of Austin. The company has 2,000 employees in Austin and is seeking to hire 400 more. Both Samsung and Tesla have recently announced plans to expand in the area. And American actor and comedian Bob Saget has died. Saget was best known for his role as a single dad on the sitcom Full House. Later, he was the wisecracking host of America's Funniest Home Videos. Detectives in Orlando, Florida, found Saget dead in a hotel room. They said there were no signs of foul play or drug use. Bob Saget was 65 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story. How are you thinking about those dynamics?
We're on a path to make this disease caused by this virus much more mild, much more contained, because we will have population immunity, we will have vaccines that are effectively knocking down severe disease, and we'll eventually have antivirals that are distributed to help limit that. So there are ways that we can control this disease, but this virus will be around for a long time.
Dr. Andrew Pekosh there, the professor at Johns Hopkins Bloomberg School of Public Health. Brilliant as always from New York City with Tom Keene and Lisa Brabbitts. I'm Jonathan Ferro. Your equity market down 6 or 7 on the S&P, down a little more than 1/10%. The main event, though, the Nasdaq, last week down about 4.5%. This morning down 56, down another 1/3%. Last week, 10-year yields up 25 basis points. This morning, a very brief breach of 180 to the upside, then back down again. Tom, 176.92 on the session, up almost a basis point.
Yeah, I take your point on 180. I mean, the fact is rates are moving up. John, am I right that at the heart of Delta, like early on when it was really serious in New York, we are trying to get to a positivity rate of 3% in New York? Is that
for testing? I don't remember, Tom. I don't remember. I do know now the number is materially higher than 3%, something close to a third.
A third of people, when they get tested, are testing.
That's the positivity rate in New York City.
I did not know that. That's amazing.
The number's unreal, Tom.
I mean, you know, we're all living this right now. We say good morning to all of you on radio and television around this nation. We're going to dive into this right now, and we do that only with experts. Joshua Sharfstein, again, with Johns Hopkins. He's with the Bloomberg School of Public Health. Of course, Mr. Bloomberg with a nodding acquaintance with his television and radio property as well. Joshua, I just want to clear the air. What's the next step for the troops in Atlanta? What's the next step for CDC?
Well, I think right now people are focused on getting the country through the Omicron wave. We expect, cases to be peaking over the next couple weeks in different places. Some places may have already reached their peak. And then hospitalizations, the peak will follow after that. Deaths, the peak will follow after that. And getting through this difficult period is really their number one challenge, because it's not just that more people are getting sick, it's that some of those people are actually working in the hospital, and it's really stressing out the ability of healthcare to provide, treatment for everyone.
The rest of us talk about this. You are doing it this weekend. I think you enjoyed a tent with 300 people as you move forward vaccinations in this nation. Dr. Sharfstein, from where you sit, are other nations doing this better? And particularly, is the United Kingdom doing Omicron better than we are?
I'm not sure any country has really figured out Omicron. I think there are other countries, though, that are willing to shut certain things down for a few weeks to try to, blunt the peak to the healthcare system. I know that certain countries in Europe have gone that route, and we'll have to see, how it works. I understand that in countries where people really follow what the government says, then you do see the cases coming down quicker. And you're taking away in those places the locations where the virus can really transmit quickly. I know, for example, Norway just said for a while that you can't sell alcohol in bars and restaurants, and so that really shut down the transmission.
When this is done, when this wave of Omicron, are we going to have reached some sort of baseline immunity to call the pandemic over?
I don't know if we'll ever call the pandemic over, in one day. I don't think so. But I do think that on the other side of this, Omicron wave, we have a chance for things to look a lot better. And, hopefully a lot of people will have immunity that will carry forward. We do not know that for sure. But at a minimum, Omicron will be behind us. And we'll be able to, hopefully put in place some stronger public health measures that can keep the virus from really disrupting our lives. Among those, rapid testing linked to treatment, the new medications, contact tracing, and other basic public health measures. We can invest in public health, and that will help us really feel like we're into the new normal and we're not stuck reeling from one COVID crisis to another.
Based on the experience in South Africa as well as United Kingdom, how long does it take once we peak, as you say we are doing in certain areas in the United States, until it sort of has rolled over and become just something that is a rarity?
Really just a few weeks, in terms of cases. Now, the healthcare system can still be coping with the fallout from that for a little while, but it's really, the models are that it really could just be a few weeks from the peak to cases way down. I mean, the explosive growth of cases on the way up with, 1 million cases a day is just mind-boggling. That comes down very quickly. And so we're trying to get there. We want to reduce the strain on the healthcare system during this period. And then on the other end, hopefully we'll be in better shape. I do think it gives us the chance that 2022 will look different than 2021. But we still need to go out and vaccinate the world. We need to do things to keep the risk of another Omicron-like virus popping up.
Doctor, just quickly on this whole issue of vaccinating the world, we all know someone here in the United States who has had Omicron now, a previous infection. Tennis star Novak Djokovic in the news at the moment, he's saying he had a previous infection in the middle of December. I'm trying to work out whether a previous infection is equal to, better or worse than being fully vaccinated. Which one provides the better protection? Do we know that?
Well, the answer to your question is probably yes. It's equal to, better, and worse, because people respond differently to prior infections. Some people have pretty mild response from the immune system, and it's not nearly as good as being vaccinated. Some people have gotten quite sick and had a very strong immune response that may be better than being vaccinated. It's just unknown. It's unclear for any person. And so when I talk to people who say, I'm not going to get vaccinated because I was sick, I say, but you're gambling. You don't know. And getting that vaccine for someone like that is an absolute benefit, no matter how much immunity you had. And it's definitely a benefit for people who actually were kind of had a glancing blow with the virus. Really protects them a lot more. So, I do think that when a lot of people get Omicron, it will create some more population immunity overall. But for any individual, it's always better to be vaccinated too.
Doctor, thank you for your perspective, your opinion. Dr. Joshua Sharfstein there of Johns Hopkins. And Tom, you can see how this is going to become a much bigger conversation given how many people are testing positive in this country right now.
Yeah, I don't think it's ended. It's just as simple as that, John. We stagger into January. I like your idea from, what, a year, 2 years ago, John, where you said maybe the year starts in March. Maybe this year more than ever, it starts in March.
I feel like we're replaying 2021 in some ways, Lisa, both in the market and in terms of the trajectory of this virus.
Yeah, especially with the rotation that we were talking about. I'm also struck by the bifurcated approach to dealing with this COVID wave, the idea that Beijing and, frankly, Hong Kong has quarantine camps for people when they come into the country versus in the United States where it's basically, you know, if you test, then you can go about your business after 5 days.
Two different worlds. I know which world I'd rather live in. I think it's fair. I'm living in it.
Yeah, I was about to say.
It's fair to say, right?
It's a mystery.
Lisa Pramis, Tom Keene, Jonathan Ferro. Equity futures down 4. We're down 0.1%. Yields higher by half a basis point. Yields on 10s briefly through 118. Now back down to 176.74. Heard on radio, seen on TV. This is Bloomberg Surveillance.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
clearly seeing a Fed that is going to move faster in terms of rate hikes, faster towards the balance sheet.
Fed hikes don't create new semiconductor chips. There's going to be a lot of inflation pressure over the next few months.
The Fed has to do a better job telling us what they're thinking, how they're thinking.
The aim for the Fed, it's not an unintended consequence, it's what they're looking to do, is tighten financial conditions.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a crazy week last week was, kicking off a brand new trading week from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market unchanged this morning on the S&P, Tom. Anything but last week on the NASDAQ.
Yeah, the NASDAQ a little bit light here, but I agree with you, John, to watch the yield market. And you mentioned the 1.80 10-year yield. And I'm sorry, you get a 180 print. You begin to think about how do you frame 195, 2%. And the answer is we're getting there. Is it grinding yet? I'm not willing to say that, John, but maybe it's going to be a grinding week up, up, up.
Well, it surged last week. 25 basis points higher on 10s, briefly through 180 this morning. Right now, Tom, 176.74. You heard Priya Misra of TD there just moments ago, and she said this Federal Reserve, Tom, when it comes to policy, they need to tighten financial conditions. Is that what they need to do?
I'm glad you bring this up because you know what we're seeing, John, and this goes off the Goldman Sachs research note making a splash this morning, and also Ms. Misra over at TD. When the facts change, I change. And a lot of the people who were not transitory but sort of in that area, you know what? The facts have changed. They're pulling forward.
We have pulled forward hikes. Lisa, we've pulled forward the conversation about balance sheet reduction, and it's not just Goldman. It's Citi, Deutsche Bank, JP Morgan, Goldman, and more. I think Bank of America also expecting a start in March.
And you've seen that move in the rates market. To your point, we're not seeing a broad-based reduction in risk. We are seeing pockets fall out, particularly the NASDAQ, particularly certain tech stocks. But there isn't this broad-based revulsion at all things risk. Is this the worst of it? And if that's the case, how much does this give the Fed a green light to go ahead?
Talked about a crazy start to the trading week last week. This week, CPI, retail sales, confirmation hearings, earnings season starts. What a week coming up. Futures ahead of that, down 4 on the S&P, down about 1/10%. On the NASDAQ 100, much lighter last week, slightly lighter this morning, down 44, -1/3%. Yields are higher, marginally, by 0.5 basis point. Earlier on this morning, though, briefly through 180. Back down below that level right now, Lisa, on 10s, 176.56.
And that's where I want to pick up, and it really dovetails into the conversation that we're going to have in about 45 minutes' time with former New York Fed President Bill Dudley joining us here on Bloomberg Surveillance. How much has the market right-sized itself with the negative yields, real yields, still deeply the case? So how much has the market woken up to the reality, and how much more waking up does it need to do when you take a look at the 10-year yield? And that is the highest, since you were saying, John, at the highest going back to January of 2020. At 10 a.m., we get U.S. wholesale inventories for the month of November. This is how much stuff the manufacturers, the retailers have left in their inventories. How much does this give a hint at what we can expect from retail sales that we get later this week? And this really dovetails into consumer sentiment from the University of Michigan, which we also get, which has been trending lower. How much are people getting a little concerned about how much inflation has been going up? And today we do have a slew of wonderful conversations with pharmaceutical Chief Executive Officers, Pfizer Chair and Chief Executive Officer Dr. Albert Bourla joining us first here on the show, as well as Robert Davis of Merck and Stan Erck of Novavax. John.
Lisa, thank you. Goldman Sachs making all the headlines this morning for Jan Hatzius' call on the Federal Reserve through 22. Matt Lazzetti of Deutsche Bank reached out to me late on Friday, Tom, and said the following. We expect liftoff in March, 4 hikes in 22, and QT to start this summer. Here's the important point on QT. Our preliminary calculations suggest that while runoff would be 300 to 400 billion in the second half of this year, it would be around 1 trillion in 2023, equal to roughly 2 hikes in total. This is important. Jim Karen of Morgan Stanley discussed this with me too, Tom. Just this interplay between the equivalence of balance sheet reduction and rate hikes and the dance between the two, how they complement each other. And if you expect more balance sheet reduction, Tom, at a faster pace earlier, do you expect fewer rate hikes or the same?
It's original economics, John. We're making it up as we go, and I like your idea of the interplay between it, which leads to the mystery of it. You know what I'm going to do? I'm going to read strategists that have been in this market and write. John Stolfus at Oppenheimer, John, he looks at all the Fed soup, and he says, maintain right-sized expectations. Everybody's got to get their brain off of up 20% a year and get to something that's more managed given the turmoil we see in our monetary policy.
It's on from the man forecasting 53.30 on the S&P 500.
Yeah, right-sized
year-end.
expectations.
Okay. Futures down 5 or 6 this morning, down a little more than 1/10%. Joining us now is Matt Dezog, CIO, a fixed income strategist for Merrill and B of A Private Bank. Matt, let's start here. With that call from Deutsche Bank, the interplay between balance sheet reduction and rate hikes. Can you walk me through how you're thinking about that right now?
Sure, and I like Tom's comment of original economics. We're kind of making it up as we go along. So obviously, there's been a sea change here, where a couple months ago we had no rate hikes, taper, ending in June, and no even talk of QT, and now we're with a hike in March, tapering ending by March, 4 hikes next year, and already talking about QT. So the important thing here is that it's important that the Fed has pivoted and changed direction, and the market's handling that quite well. But in terms of QT, the minutes talked about them discussing it, talking about the pace of it, possibly accelerating it, but it's a little too early to actually worry about QT at this point. Focus on the rate hike in March, focus on the taper ending, and then we're going to see at that point what is absolutely necessary. So we're still a good 6 months away from that. Again, it's very important to get that into the market's consciousness. It's great to get it out there. It's the elephant in the room. We might as well talk about it, but just getting it out there for now is enough, and they don't have to actually quantitatively tighten. And if you remember, it didn't work out very well in 2018, 2019, and they very quickly changed pace.
But Matthew, if they do not follow through on some sort of quantitative tightening, then do you expect the yield curve to flatten to an uncomfortable place, especially as they raise rates?
So I think that, I'm not saying they will do QT or would do QT. I think they will get to QT, but it's a decision that doesn't need to be made now. And interestingly, the correlation between quantitative easing and rates is not that clear. A lot of times when the Fed stops quantitative easing or quantitatively tightens, rates don't go up, they actually go down because they're not adding the accommodation that's necessary. So that's not a truism. That's not always going to be the case that, hey, they stopped QE and rates actually go down, not up. It depends on the conditions, but it's very possible. So they will look to the yield curve not as an outcome to what they're doing, but more as an input into their deliberations. And we've been telling folks for a while now, watch the 10s, 30s curve. It flattened from 85 basis points in February, March of last year to, the low 30s. And at that point, we're saying if it keeps going, keep an eye on that. But notice what's happened is they've changed policy. It's actually flattened out and started rising into the 40. And 40 bips on 10s, 30s is steep enough for now.
Matt, at Bank of America Private Bank, as with every private bank, you must be overwhelmed with our listeners and viewers who say, I didn't participate last year like I should have. What do you say to someone who feels like they missed out on this great bull market, whether year 1, year 2, or year 3?
Yeah, that is always a way to get into trouble, looking in the rearview mirror and feeling that you missed something out, or looking at the guy next door and thinking he made more money than you. So we would encourage people strongly not to worry about any past gains and look forward. And Lisa made a great comment at the start of the section here, discussing that there were pockets in equity markets and pockets in risk assets that are coming down. And this has, again, been part of our guidance here, that we want those individual investors who feel they missed out to participate, but be balanced and diversified. And in particular, make sure you have exposure to value stocks, make sure you have exposure to cyclical stocks. The higher duration equities, as we call it, tech as an example, where earnings are farther out in the future, higher rates can affect the present value of those cash flows a lot more. And so you really want to be diversified here. Value has done fairly well versus growth. We think that we're early in that stage. Again, we're not saying be totally overweight value. we're saying this is an environment you want to be diversified across your equities and across your fixed income. Again, still more equities than fixed income. We're still more bullish on equities relative to fixed income expectations, but be diversified. Make sure you have cyclical and value exposure, and don't be tilted too much in any direction, but certainly don't be as overweight the growthy, high duration equities that have performed well. Do not chase that last year's performance.
And if you live next door to Tom Keene, don't feel bad. You didn't miss anything. Matt Dizok of Merrill and Bank of America Private Bank. Just imagine that. You're living next door to someone that made 30% last year. You get jealous, don't you? Lisa, you know if you live next door to Tom, that's not the case.
In triple leverage all cash. Although he does, I hear, make a mean Negroni. So maybe you'd be jealous of his Negroni
He
making.
makes up for that.
Yes, there you go. Honestly, I think that there is a real interesting consensus being formed here. And what is compelling to me is that this rotation into value, John, seems to be catching speed. But people think that mid-year, it's going to shift back to growth, that people are going to get a little bit more concerned about the trajectory of the economy. And then people will pick up some of those tech stocks on the cheap. And to me, it seems like there's a growing shift towards some sort of consensus around that.
It's so hard to predict that stuff, but Tom, that was the call from Laurie Calvasina of RBC about an hour ago on this program.
I'm going to stay where I was 12 months ago, John, and just say, watch what corporations do. John, the profits are so great this time around. A lot of these people on their conference calls are going to be apologizing for their success. Granted, the view forward is key, and how do they recalibrate given the Omicron uncertainty? Citigroup just out with an enthusiastic note on Delta Airlines. Imagine the month. Imagine the 30 days Bastian and the Delta team have had.
Saw them do the same thing with the European names, the European airlines, particularly Lufthansa, in the last couple of weeks. Tom, if you had to take your pick right now, your focus this week, the data, CPI, retail sales, or earnings season? Earnings season kicking off with JP Morgan.
Earnings season to me is factors more important right now because the parlor game of the Fed is so original. John, we don't understand how original this is in the struggle that market economists are having.
Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market down negative about 0.2% from New York City this Monday morning for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The Biden administration and U.S. allies may impose export restrictions on Russia if Vladimir Putin seizes more of Ukraine. They are discussing limits on sensitive technology and electronics. Meanwhile, in Geneva, senior American and Russian officials begin talks aimed at easing tensions over the Ukrainian situation later today. Now, Omicron has flared in a port city that borders Beijing, and it did spread inland before Chinese officials detected it. That brings a variant to the doorstep of the capital less than a month before the Winter Olympics begin. Officials in the city of Tianjin have told its 4 million residents not to leave the town unless it is essential. Goldman Sachs is forecasting that the Federal Reserve will probably raise interest rates 4 times this year. A research note also says the central bank will start its balance sheet runoff in July, if not earlier. In its December meeting minutes, Fed officials signaled they are preparing to move quicker than last time they tightened monetary policy. Tennis star Novak Djokovic may be able to stay in Australia and go for a record 21st Grand Slam victory. A judge has quashed the cancellation of his visa and ordered his release from detention in a hotel. Djokovic's lawyers argue that he was granted a valid exemption to vaccination rules after he had tested positive for COVID last month. Intel is on the brink of losing its status as the world's largest chip maker. For the first 3 quarters of 2021, Samsung held a narrow lead in sales. The final numbers for the full year will be available in late January, but it seems likely that Intel will drop into second place. The company still produces the vast majority of the world's computer processors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does.
When you think about schools in particular and children, where we've seen pediatric hospitalizations actually on the rise amid the spread of this variant, do you think keeping schools open is the right move?
If done well, school is a relatively safe environment for kids. Masking, tests, especially during the surge of cases, I think it is very important for kids to be in school, and I think the chance that school becomes an explosive source of new infections is low with precautions.
10 million cases in just a week. Are we reaching a peak of this wave considering how quickly it is spreading through the population?
I think at a certain point it really has to slow down, and that's probably within a couple weeks or a few weeks away. And that's, I think, going to be good news. The question is, can we keep hospitalizations down enough during this period so we're not swamping hospitals?
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
I want to be clear. I'm confident the Federal Reserve will act to achieve their dual goals of full employment at stable prices and make sure the price increases do not become entrenched over a long term with the independence that they need.
The President of the United States, President Joe Biden, from New York City with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down another 100 points on the NASDAQ 100, down 0.7%. Keep an eye on that. A move lower last week of 4.5%. We're down and down hard again. On the S&P 500, down about 15 points. A marginal move lower, down 1/3%. In the bond market, briefly through 180, back down to 177 on 10s, 176.92. Yields higher by almost a basis point. I have no doubt if you're on social media, you saw one or two things over the weekend. Adverts, commercials for sports betting, one, and this reference, Tom, to this game, Wordle. I have no idea what Wordle is. You have no idea what Wordle is. Lisa knows what Wordle is. Lisa
Abramowitz.
What is Wordle?
It's a game where you guess 5 letters and you guess a word and you get numbers of chances and it tells you which letters are correct or not. I will just tell you, I find it incredibly entertaining. If A, you have COVID, or B, you're in the emergency room with a child who broke a bone. Either one, Wordle really is wonderful, I will say.
Is this an app or is it a website?
It's a website.
Okay.
I'm glad we're doing this.
I just want Tom.
Really
Tom,
pleased.
had you seen the mentions to that game over the weekend?
Discussion.
No, I saw
Every
the
time I opened
sports
the
betting,
app,
though.
Twitter, that was all that was there.
No,
that and the sports betting.
I was so upset, and it's confirmed this morning. Thank you to the gentleman out on Twitter who confirmed what I observed. John, a senior coffee at McDonald's, not that you'd know anything about that, skyrockets, I say, to 87 cents.
It's gone up in price?
Yeah, I about fell over.
I love the transition there, Tom.
Well, we're talking inflation with Emily Wilkins, and I mean,
Is that what we're doing?
you know, Wordle, senior. Well, I don't get Wordle.
It's not 5 letters.
Emily, do you get Wordle?
I absolutely get Wordle. I've rocked Wordle this last week.
Okay.
How
Emily
else
Wilkins
am I going to
joins-
post an annoying grid of colored squares on my Twitter?
Emily Wilkins joins us now in Washington, expert at Wordle, and also at what the Biden administration is going to do about inflation. Jeff Stein in the Post with a cover article this morning, Emily, about inflation, and all it is a blame game. There's no other way to put it. He's got an economist at Treasury who's pretty competent. What is Secretary Yellen telling him about the blame game of going after Apple or name the corporation because it's their fault?
I mean, look, the Biden administration, they came out initially saying, hey, the reason that we're seeing this inflation, it's just temporary, it's due to COVID, it's going to go back down. And we've seen the White House kind of back off of those talking points as you've seen month after month of higher inflation numbers. And you've really seen Republicans step up and just start aggressively attacking Democrats on this particular issue because they know that it's impacting average Americans in their daily life. And a lot of Democrats on Capitol Hill are holding their breath at this point. They know that if inflation continues, that's going to make a difficult midterm for Democrats that much worse. And that's probably going to lead to big gains for Republicans in the midterms.
I look at the inflation story, though. I mean, we can blame Saudi Arabia. That's convenient. Francisco Blanche, folks, with a really important interview coming up, is, well, if there's a blame game, don't we have to turn our attention to the fact we had a massive fiscal expansion given a pandemic of our lifetime?
And that's part of the thing that Congress is looking at. I mean, that's part of the reason why we haven't seen any progress on President Biden's social spending and tax plan, the so-called Build Back Better. One of Joe Manchin's main concerns is for the inflation component of it and what that could do to the markets. That's part of the reason that we haven't seen it go forward at this point. There's also some discussion as we look at, there's been talk, of course, I know you guys discussed this with Anne Marie, of another piece of stimulus specifically for Omicron. But if you look at the price tag, I mean, for previous ones, we talked about trillions, we talked about hundreds of billions. This one, the Washington Post has reported, would be much smaller than that. And I think part of that is coming as Congress is becoming more and more wary of potentially adding more funding into the market, and that inflation is becoming a bigger and bigger concern within Washington.
Emily, there's been a common belief that no government wants to see a hawkish Federal Reserve. And not only are we be talking about more stimulus, more spending, but the confirmation hearings this week of Fed Chair Jay Powell, as well as Governor Brainerd. How much are we going to see a shift in that belief, and that governments actually, this government, would like to see perhaps a more hawkish Federal Reserve?
Well, I think the recent jobs numbers, several recent jobs reports, have really shaken up members of Congress. They want to know that they are going to start seeing better employment numbers. They're going to want to start seeing inflation going down. These are the things that Powell and Brainerd are going to be grilled on when they sit in front of lawmakers in the next week. At this point, I think everyone's just trying to figure out a way to really get out and get past this pandemic. That's been President Biden's stated goal from the beginning, but you've seen Delta and Omicron really throw that off track. And so at this point, there is a question of what can the Fed do? Obviously, this is a global issue. There is many countries that are being impacted by these problems at the time. But it's just a big question of what, if any, power the Fed has. And you've even seen President Biden, for those most recent job numbers, really call on the Fed to start addressing these issues.
Do we have any update on when we're going to get the other nominations for the open seats that we have coming up on the Fed?
We've started to see names tossed around, so that's certainly a good sign that we're actually going to see something concrete coming up soon. Biden's making several different speeches this week. He's going to be heading down to Atlanta tomorrow. That's mostly going to be focused on voting rights. On Thursday, he's going to be talking about the government response to COVID. Maybe that could be a time for him to begin discussing the his other nominees to the Fed board. But it's certainly something that he needs to start thinking about. We are in 2022 right now, and a number of these deadlines are coming up.
Emily, based on the coloured squares that people post to Twitter, how do I know if they're good or not? Are they all green? Fewer yellow ones? What is it?
You want the bottom row. If the bottom row is all green, it means they got it, and you want to judge people by how long it took them. So someone who got the puzzle right in 3 rows did a better job than someone who got the puzzle right in 6.
Lisa and Emily, surveillance Wordle, here we go. The letter R is in the wrong spot. Okay?
Thanks.
The letter F is in the correct spot. The letter K is not in the word. How we doing, folks?
Did you just play the game, Tom?
I'm trying here.
How did that work out?
John, this is the difference between us and them and others.
Let's see how long this fad lasts. I'll try it later. Emily, thank you.
Hold on a second.
Emily Wilkins down in D.C. Go on, Lisa.
Which trend? Wordle or Tom playing word games?
I thought Wordle was a fad, a bit of a trend.
while we're on air talking about the political backdrop in Washington, D.C. I'm just wondering, which one are you talking about?
If you want a serious note on the unemployment story, Tom, I think the 3 handle changed the game for a lot of banks.
Yes,
including Citi.
Yes.
Citi and Andrew Hollenhorst saying 3.9% removes the last rationale for keeping rates low. We expect the first hike in March.
Yeah.
That changed the game for a lot of people.
Revisions, upset. We'll get out another 30 days and get another jobs report. John, look where claims are. It's the most elegant chart out there. You're dead on about under 4%. When the facts change, they change. That's what everybody's doing in the Fed game.
Tom Keene, Lisa Abramowitz,
question.
Jonathan Ferro. The transitions on this show are beautiful, aren't they? Futures down 13, down a third of 1%. Yields higher by half a basis point to 176.74.
No letter E is in this word.
Briefly through 180 and 10s. What have I started with TK?
Seriously.
Tom, you've got to, when you've done this, you've got to post the squares to Twitter.
Can you do this with something stronger than tape?
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
No bounce back on the Nasdaq 100 this morning. Good morning to you all. The Nasdaq 100 down another 100 points plus. Negative 0.7%. Last week down 4.5%. We take more weight off of last year's rally. On the S&P 500, down about 1/3 of 1%. The story of the last week, the story year to date, has been that rotation we've been talking about. And look at the performance gap opening up. Switch up the board. And let's just cherry pick a little bit here, TK, but go with me. The Nasdaq 100 year to date, over the last week plus, down 4.5%. The S&P 500 banks up almost 10%, 9-10 percentage points higher, Tom, year to date, off the back of what's happened in that bond market. That's the performance gap that's already opened up early in 22.
Yeah, I'm going to give you, it's a value gap, and it also has to do with what we're going to see on the earnings season. There's a real zeitgeist sense this weekend, John, that the banks are going to show bang-up earnings as well. So there's the gap for what, 1 week?
JP Morgan kicking things off this Friday. Tom, it depends on this bond market too, doesn't it? Switch up the board and get to the bond market. 2s, 10s and 30s. A key feature of this has been that big move higher on 10-year yields, up 25 basis points on 10s. Curve also steeper, though, by 12. The whole curve's come up and shifted some. Steeper curve, the forecast of higher interest rates, yields on 2s at 87 basis points, on 10s briefly through 180 at 176.56. And Tom, the conversation now has got to shift towards, if you're not already there, the interplay between balance sheet reduction and your call for interest rate hikes. If you expect an earlier move on balance sheet reduction, do you trim the expectations you have for interest rate hikes? Goldman this year say no. They look for 4 hikes this year, every one coming every quarter, Tom, and they expect the balance sheet reduction as well. And I think it's going to be interesting to see from house to house how they forecast the interplay between balance sheet reduction and rate hike calls through 22 and through 23.
It's the movable parts, and we've discussed this morning, John. There's a lot of movable parts. I would suggest the movable parts of Romaine's world is a lot more focused, which is what you do on revenues, what you do on margin. That's what's going to matter.
Let's get to Romaine's world. Right now, 10s, 176.56. That's the cross-asset price action. With your single names this morning, your morning movers. Here's Romaine. Morning, Romaine.
Hey, good morning, John. Let's take a look right now at a big deal in the space out there. Take-Two Interactive, a traditional mobile video game company, actually seeking to buy Zynga, a mobile video game maker here. Shares up 52% here. We should point out this is $9.86 a share is what Take-Two is offering for this company right now. This is about a 60% premium to where we were on Friday. But keep an eye on this space because this is more than just about content here. The CEO of Zynga, Frank Cabot, is going to join Take-Two Interactive to lead their mobile gaming business. This is a big deal because Take-Two has had a lot of trouble building out that mobile business. Frank Cabot, he done a lot of work there at Zynga. Before that, he ran EA's mobile business. So this could be a huge coup for Take-Two. Nevertheless, shares down about 8.5%. This is a cash and stock deal. A big part of that, about 2/3, is going to be stock. That's probably why you're seeing Take-Two down 8.5%. Keep an eye on some of the other video game companies out there. Also could be in play. Playtika, which went public just about a year ago today, up about 6% here in the pre-market. Flip of the board, and let's get to a couple other names real quick here. Viacom, CBS, Discovery, two of the best performers in the S&P 500 this year. Discovery, number 1, Viacom, number 2, both getting upgrades. Discovery over at Bank of America, Viacom over at Deutsche Bank, both to buy some relatively strong streaming numbers. Lululemon shares down about 5%, though, in the pre-market here after giving some preliminary numbers for its fiscal Q4 numbers, Tom.
Romaine, thank you so much. Greatly appreciate that this morning. Right now, as we recalibrate after the tumultuous week, we're making jokes about it, but yeah, last week was nuts. Kristen Bitterly joins us, and she knows out of Notre Dame and Jenkins Nanovic Hall that you need the right language at the right time. And Kristen, to me, it's super intense. In your research note, you talk about a super intense moment, the super intense week we had last week. How do we find calm in these markets?
So finding calm right now, I think the one thing that we can look to is actually earnings. I think what we're focused on over the next couple of weeks is earnings season, because everything that's going on, whether it's the substantial movement in rates, fear of inflation, the one thing that will combat that is still record high profitability. So it's not just about what happened in Q4, but I think more importantly, it's the forward-looking guidance that we will also get from those management teams that previously have held back. But if you're able to withstand some of the pricing pressure, if you're able to withstand some of the supply chain disruptions, those are the quality companies that we want to be invested in and that we have been investing in. And that's really our positioning for 2022.
You have the advantage of Citi Research. I know you had a research note out this morning on Delta shock. They'll survive, folks. Ed Bastian will get it done, just as, one industry that is super intense with fear right now. What do you glean from your sell side troops? They're going into conference conference calls. They're going to go into the forecast, the expectations forward. But what do you glean from Citigroup's sell side right now that helps you?
I think the biggest thing is that this is not a debate about growth versus value. So a lot of people who are discussing the start to this year and this big rotation that we've seen into banks, into energy, it feels like deja vu a little bit in 2021. That is not our base case or thesis. And again, I go back to this quality companies. We are not trying to make a decision about whether to be invested in growth or value. We want to be invested in quality. And so the interesting thing that I think the first week has really provided us with is when you look at this tech sell-off, I think the one thing that makes it a little bit different than what we saw throughout the entirety of 2021, because we did see that delineation between winners and losers. What we saw with this tech sell-off, it was actually the breadth of it that has really accelerated. So out of the NASDAQ 100, you have 38 single stocks that are actually down 20% or more from their 52-week highs. You have 65 have dropped more than 10%. That breadth is going to create some opportunities, particularly in some of the subsectors that we like payments and cybersecurity. So I think this is not an either or a mean reversion trade, but leaning into those strong companies and quality.
Are you already starting to see some of those quality names, as you identify them, start to bottom out when it comes to the sell-off?
I'm not sure if we've seen them entirely bottom out. What we have seen is, and I think this is the best way in terms of how our investors are currently looking at this and how we're advising them, take advantage of some of the volatility there, the volatility in terms of the rates increase, the volatility that we're seeing in terms of anticipation of earnings. And one way to kind of build those positions in quality companies that you like, that you want to hold, or those sectors that I mentioned, like cybersecurity, is actually to monetize that volatility. And right now, you can get a double-digit yield to buy into that at a 5%, 10% pullback from these levels. So ironically, this volatility around tech is creating some opportunity for us.
Kristen, a lot of people would agree with you, but the timing here, I think there's a lot of disagreement. And some people have been saying, in particular, Lori Calvasina of RBC, that there is more sell-off to come and that you are going to see perhaps even those growth names take another hit before they become attractive later in the year. Why do you think now is a good time to get in rather than waiting until people kind of shake out all of these new rate hiking views?
I think the thing is that there is going to be volatility. So whether it's a question of the challenge that investors have is really kind of delineating what their time frame is, kind of short-term, medium-term, long-term. I think individual investors really do have that benefit of trying to take the long-term view, which is why you can have that separation between the quality, as I mentioned, as well as some of those long-term unstoppable trends that will really endure. But I think the genesis of volatility, I'm actually going to bring this back to the rates market, because I think this is important and what the Fed's doing. Everyone's talking about rate hikes, and everyone's saying that, okay, whether it's 3, whether it's 4, we're anticipating that. We anticipated the pullback and cessation of bond purchases, but this pivot to the balance sheet runoff and really that getting acceleration, I think we're going to see some choppy markets for the next couple of months when it comes to rates, because you don't have the Fed being that consistent buyer, particularly in areas like mortgage-backed securities. You don't have that kind of bid every single day to that market, which is then going to rely on private markets. And then I think we're going to see some balancing out over the next couple of months.
Kristen, wonderful, as always. Kristen Biddley there of Citi Private Bank. It's difficult to fully internalize the Fed shift here, Lisa, without a clear view, some clarity on what the interplay between the balance sheet reduction and rate hikes will actually be, what it will look like once they get going.
And the fact that the Fed does not have as clear of a sense of the effect that a balance sheet reduction will have on markets is also creating that much more uncertainty. They've been hesitant to bring this into play as long as they have, simply because of that uncertainty that Fed policy has around something that doesn't have that much precedent.
Just caught up with Kristen Biddley of Citi Private Bank for people just tuning in. Didn't want to ask Kristen about this, Tom, but did you see the story on Friday on Citi? I'll read the quote for you. Office workers who don't comply by January 14th, this is their vaccine mandate, will be placed on unpaid leave, and their last day of employment will come at the end of the month. This according to a message to staff seen by Bloomberg. Tom, the message, very, very simple. No jab, no job. That's the message coming from Citi on Wall Street and beyond.
Noted over the weekend, and John, I don't have any strong opinion on this. Are we going to see a follow-on to this? I got to believe you're going to. There was a really important Camilla Cavendish essay in the Financial Times this weekend, is work from home working? And she went, you know, as Camilla only would do, to actual academic research and the productivity of work from home maybe is not there. Work from hotels really working.
Did that work out, TK?
That worked out okay.
That worked out beautifully. I think it's going to differ from bank to bank, or differ from leader to leader.
Yeah.
What we've seen is a continuous trend, Lisa. With every single wave, back away, the wave passes, step back in. Let's get back to work. Do you remember last year when it felt like the endemic was really upon us here in New York City? It was the end of May going into summer, and there was a feeling on Wall Street, we'll see you after Labor Day. Yeah. September, everybody needs to get back into the office. I tell you, Lisa, if this plays out the way a lot of people think it'll play out, which is that Omicron fades back end of spring, let's get to May again. Do you think they're going to wait till Labor Day again to say get back into the office? No. I imagine they come out all guns blazing. Let's go, let's go, let's go. Your summer is going to be in the office.
And you've already seen that. I mean, banks actually taking out new leases in property in New York City. I mean, it's not that the office is dead. I think what you're going to see, though, and this is what I keep hearing, days where everyone has to come in, and then other days that there is more flexibility.
You can't play Wordle work from home.
You can't.
No.
I think that's exactly what's been happening.
Thank you. The letter E is in the wrong
doing
spot.
It
the letter
in
E
the
is in the wrong spot.
On air.
Tom Keene.
Just saying.
Lisa Bramett and Jonathan Ferro. Futures down 23, down 0.5% on the S&P. We are now down 1% on the NASDAQ 100. Negative 0.97% lower after last week's loss to 4.5%. We'll stay focused on that one for you. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Inflation in the US has probably hit the fastest pace in 4 decades. The Consumer Price Index comes out on Wednesday, and it is forecast to rise 7% through the year through December. That helps explain a shift in the Federal Reserve's approach to monetary policy, along with more consumer anxiety about the economy. In Kazakhstan, security forces backed by Russian-led troops are restoring control after crushing demonstrations. The government says almost 6,000 people have been detained. According to state TV, 164 people were killed. The real number is thought to be far higher. Tennis star Novak Djokovic has won a court battle to stay in Australia and play the Open. A judge reinstated his visa, which was cancelled after his arrival last week because officials decided he should not be exempt from vaccination requirements. The judge also ordered that Djokovic should be released from detention. Still, Australia's government is threatening to cancel Djokovic's visa for a second time. Congresswoman Alexandria Ocasio-Cortez has tested positive for the coronavirus. The New York Democrat is fully vaccinated and has had a booster shot. Her office says she is experiencing symptoms and is recovering at home. A big takeover today in the video game industry. Take-Two Interactive has agreed to buy Zynga in cash and a stock deal valued at about $12.7 billion. That represents a 64% premium in Zynga's closing price on Friday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I think they can go much, much higher. They've got to equal what we're seeing with inflation at the end of the day, because people are not going to be buying treasuries if they see that they're only getting 2 or 3%, but inflation is 7, 8, 9, 10%. So at the end of the day, those rates have to go up.
One side of the trade with Mark Mobius there, the founding partner and Mobius Capital Partners from New York City this morning. Good morning to you all. Lisa Bramett, Tom Keene and Jonathan Ferro. Futures down 22 on the S&P, down 0.5%. There's the move on the NASDAQ, down 153. We're negative almost 1 full percentage point there as yields briefly breach 180, 177.80. Now yields higher by a couple of basis points. I said Mark Mobius was one side of the trade. There is another one, PGIM. Mike Collins on Friday, Tom, telling me now for him is a buy. There are limits to how far the Fed will take it. He's comfortable looking at the 10-year and the 30-year right now where it is.
It's going to be interesting to see. We are going to stop the show right now. John Farrell, Lisa Bramett, and myself, we welcome all of you on radio and TV to maybe the first great discussion of the year. William Dudley is not the normal economist. Yes, his work at Goldman Sachs out of Berkeley, but far more his tenure at the New York Federal Reserve. And he has been very overt in writing, not weekly, but pretty much twice monthly for Bloomberg Opinion. And today he issues, without question, his most scathing essay on where our central bank is. Bill, what's it like to write with that language of a remarkable and surreal Fed economics? Are you getting criticism from inside the Fed?
I'm sure it doesn't make people there happy, but the reality is I got to call it like I see it. And what I see right now is a Federal Reserve that has a very benign forecast relative to what's actually happening on inflation. If you look at their forecast that they published at the December FOMC meeting, they have inflation melting away to 2.1% in 2024, even though they don't take monetary policy to a tight setting. The end of 2024, the federal funds rate is 2.1% below what they think is neutral. So how does the inflation magically disappear if the Federal Reserve is actually not making monetary policy tight? That's the question I want to raise in this piece.
Bill Dudley, Alan Greenspan in 1998 at least, talking about the measurement and measured and the idea of a graduation, a step-by-step approach. Alan Blinder in an essay in 2005 said the Greenspan standard is suspect. Are we going back to Arthur Burns and the pipe smoke where we're going to lose quarter point measured and start to see some real jumps?
I think they're going to go fairly slow at first, but because they think that the inflation pressures that we're seeing right now are going to subside as we go through the first half of the year. But the real new information is the tightness of the labor market and the fact that that tightness of the labor market is resulting in higher wages above what's consistent with 2% inflation. So I think even if the initial impulse of inflation turns out to be transitory, they now have a problem because the labor market's sufficiently tight that wages are going to continue to accelerate.
Bill, in your piece, you reiterate your call for 3 to 4% as the potential end rate for the Fed funds figure. I'm struck by the fact that you include the idea of an end rate for inflation at 2.5 to 3%, which is actually a commonplace suggestion. What happens to risk markets if the Fed funds rate gets to 3 or 4%? Do you think that this economy can sustain that?
Well, I think that's the fundamental question. In 2004, 2006, the economy sustained the Fed taking the federal funds rate from 1% to 5.25%. Yet in 2016 to 19, the economy didn't do so well with the Fed taking the federal funds rate to, up a little bit over 2%. So I think that's the fundamental question. How do markets react to Fed tightening? I think that right now, this idea, though, that the Fed is a small amount of tightening is going to cause markets to go down precipitously, and that's going to cause the Fed to stop. I don't think that's the most likely outcome.
If you think that inflation subsiding at 2.5 to 3% would result in what could be a crippling Fed funds rate, then are you saying that we need an inflation rate below 2.5% to have an economy that is sustainable over the next decade?
I don't think a 3 to 4% federal funds rate is crippling in any way. It's only unusually high relative to the last 10 years. It's actually pretty low relative to the last 30 or 40 years. So I think the economy can do just fine with the federal funds rate in that range. I think what markets are really mispricing is the fact that the Fed is actually going to have to move to a tight monetary policy setting at some point. The Fed has turned more hawkish in the very near term, so a lot more rate hikes are being priced in 2022. But the terminal federal funds rate the market's expecting is still very low, only around 2% or so.
But what's important here, and I think to summarize the message, you think for inflation to come lower, the Fed needs to engineer tighter financial conditions. Bill, I'm trying to understand from your standpoint, where do you think that tightness begins? Where do you think it is? 1.5%, 2%, 2.5%? When does it start to become restrictive and where we can sit here and say the Fed is now tightening?
Well, I think it's when the markets start to price in more tightening than what they've priced in at this point in time. I mean, if the Fed just delivers what's priced in today, I don't think markets react very much because it's already priced in. So the Federal Reserve essentially has to go further than what the market anticipates for the markets to react. I think what will happen is first bond yields will go up further. We'll probably see bond yields in the 2.5%, 3% range. And once we have higher 10-year Treasury note yields, that will start to weigh on the stock market a little bit more. And other, risk assets like, say, cryptocurrencies, for example.
But what you just said, though, the original piece of this is that you think when that happens, the Fed doesn't back off. It's not the old playbook.
Well, the Fed has to do its job at the end of the day. I mean, if you try to defer the fight against inflation, all you do is get more inflation. So it's not like, trying to be a nice guy gets you to a better place. We sort of saw that mistake in the early 1970s. So I think the Federal Reserve at the end of the day will do its job. I think it's just slow I think, to realize right now the consequences of the tight labor market, which they've engineered at this point.
Bill Dudley, I want to go back to Dudley McKelvey, Goldman Sachs. There's not a moment to lose. That's what I hear in your essay this morning. It's like, okay, guys, let's get it going. The Taylor rule is described on the Bloomberg is stunning. It's something you and I never would have envisioned. John Taylor of Stanford never would have envisioned where we are. Which moves quicker, the Taylor rule coming down with all its moving parts, or does the Fed move up at a greater speed?
Well, I don't think the Taylor rule is really that relevant to what the Fed is doing right now. I mean, if you listen to Chair Powell, he talks about the importance of financial conditions. And I think that's the key issue. The financial conditions today are extremely accommodative. To slow the economy down, the Fed needs to make financial conditions less accommodative. How do they do that? They raise short-term rates. They raise short-term rates more and faster than what markets expect.
Bill, how does balance sheet reduction play into this as well, from your standpoint?
Well, it's interesting that there seems to be a growing sentiment that the balance sheet reduction is going to happen sooner than last time, not just in time, but also in terms of the level of interest rates where the Fed is going to start the balance sheet normalization process. Mary Daly last week talked about getting going, after a couple of rate hikes. I find that a little bit surprising, given that the Fed officials have also said that they want the federal funds rate to be the primary tool of monetary policy. Well, if you want the federal funds rate to be the primary tool of monetary policy, you need to get the federal funds rate up so it can actually react to adverse shocks in the economy, so you can push it back down. So I think the case for being a little bit more patient with the balance sheet is still pretty strong, but it certainly looks like, judging from Fed officials' commentary, that they're going to go a little bit faster this time, not just in time, but also in terms of what level of interest rates we have to get to before they start to normalize the balance sheet.
What's your sense of how much they should raise rates this year?
I think they should go faster than what's priced into the market. I mean, obviously, it's going to depend a bit on how the economy evolves. But my best guess is, that they need to do at least 4 or 5 rate hikes this year. And it wouldn't strike me at all if we get into an every meeting kind of cycle at some point.
Bill, what went wrong for this Federal Reserve? Let's finish there. What went wrong?
Well, I think there were, essentially 4 mistakes that were made. Number one, the way they operationalized the 2% average inflation targeting regime by saying that they're not going to even begin to lift off until they've satisfied the goals of inflation at 2%, expected to be above 2% in the future, and at full employment. So that means the starting point for monetary policy liftoff is the economy is already overheating. Number two, I think they were wrong about the labor market. I think they were surprised by how fast the labor market tightened. Participation rate has not come back to the degree that they were expecting. Third, they were surprised, I think, about inflation. The transitory story hasn't played out very well. I think a lot of the inflation pressures we're seeing are transitory, but that's lasting longer for a lot longer at a lot higher rate than they anticipated. And then finally, I think they were a little bit too concerned about worrying about a taper tantrum. So I think they were a little bit too gentle in terms of their communication to financial markets because they were worried that was going to provoke a sell-off in the bond market. And I think, in fact, the problem right now is that the markets aren't taking them seriously enough.
Bill, just wonderful. You've been warning about this for more than 6 months. Bill Dudley of Bloomberg Opinion and, of course, the former president of the New York Fed. And this goes quite neatly together with what Mohamed El-Erian wrote about on Friday, Lisa, when he says, and I suspect that despite recent moves, the central bank is still lagging economic developments on the ground. It is probable that its policy signaling in the next few months will further undermine markets' notion of an automatic Fed put. And that final piece is exactly what I just heard from Bill Dudley.
This idea that the Fed does not want to stop a tantrum. And the market has not had a tantrum yet. So if the market has not had a tantrum, do they need to spur it by getting it a little bit more concerned in order to actually tighten monetary conditions? And to me, this is really the wild card for the next couple of months.
Tom, they want to engineer it. That should be the objective. That was the message we just got from the former New York Fed president.
I think they're making it up as they go off absolutely historic fiscal expansion, original expansion off of a natural disaster, the pandemic. I'm going to cut them some slack. But with that said, Bill Dudley brings up some important points. John, I just took the Taylor rule as seen on the Bloomberg and I plugged in Adam Posen and Olivier Blanchard's 3% inflation at the Peterson Institute. And I'll be honest, the Taylor rule approximation barely moves. It's stunning how far out extended it is.
Lisa?
I'm just still trying to get my head around what a 3 to 4% Fed funds rate would mean. And we just heard from Bill Dudley that he thinks the market can absolutely handle that. Perhaps it can handle that, but just think how it rejiggers junk bond yields that are currently at 4% all in. Just think how it rejiggers the NASDAQ valuation. How much can markets get ahead of something that seems completely anachronistic to today's market?
Isn't that what's fascinating about this moment, looking out to 22, that you can have the likes of Bill Dudley saying we need to get to 3 to do anything, we need to get to a restrictive policy stance, the likes of, say, Mike Collins at PGIM saying that if you go to 1%, that's enough and this market is going to back up big time?
I think this year is fascinating. I'm actually really interested to see how things develop, and honestly, very smart people making very good arguments, and either could be right.
Lisa Bramage, Tom Keene, and Jonathan Ferro. Your equity market shaping up as follows. The S&P down 28, down 0.6%. And there's the move on the NASDAQ 100, down 175, negative more than 1 percentage point, adding to the losses of last week of about 4.5%. More still to come from New York City, a beautiful one. As always, heard on radio, seen on TV. This is Bloomberg.
All that chocolate makes it to the supermarkets in time for Christmas. I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, Toffee Crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. And this Xmas is its first big test, and so far, it looks like things are going well.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, of the sort of tribal aspects of what fashion does.
Seems to be pricing in a very hawkish Fed, but the equity market does not seem to be doing that.
I think the Fed is trying to inject risk in the market that they will respond.
We don't have a really good experience for the ability of markets to kind of calmly go through a tightening cycle.
Overall, policy remains accommodating.
Investors are hard-pressed to find a better place to invest for the future than the United States.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast from our studios in New York, all together again. We welcome you on radio and television. It's been a softer market today, and suddenly, John, the market's moving. In the last 10 minutes, John, a real deterioration in the tape.
Yeah, Tom, the Nasdaq 100 down more than 200 now, negative 1.4%. And if Bill Dudley, formerly of the New York Fed and now of Bloomberg Opinion, Tom, if he's right and the Fed funds rate needs to peak 3 to 4% in that range, then I think it's fair to say we're not done here, Tom. I think it's fair to say 10-year yields don't peak at 180. Right now, 176.92.
If you're part of Global Wall Street, if you're just worried about your retirement plan, you need to stay with us for the next 10 minutes. RJ Gallo with us on fixed income. Francisco Blanch scheduled to join as well on $100 a barrel oil. John Farrow, the zeitgeist over the weekend, you were out front on it with the NASDAQ leading the way, but suddenly a deterioration. Was it because of what Dudley said?
I don't think it's because of what Dudley says, but what Dudley says is part of the broader conversation, Tom. How far does this Fed need to push it to tighten financial conditions? And when we think about tighter financial conditions, that's not an undesired fallout of what we're talking about here. That could be the objective for this Federal Reserve. Not an undesirable fallout of what they're doing, Tom, an objective, and that's different.
Pushing against the caution here is that if you do get higher yields, global finance will step in and buy America. Lisa Abramowitz, those auctions are actually more important now as we move into January.
Wow, I'm so excited that you're getting excited about the bond auctions that we have coming up. 3s, 10s on Wednesday, and onward. Honestly, I'm still trying to get my head around the idea of a 3 to 4% Fed funds rate, as Bill Dudley was talking about, and this idea that the rate would have to be that high if inflation rested at 2.5% to 3%. How does negative real yield play into this? How does that global backdrop of demand that you were just talking about, Tom, play into the likelihood of Treasury yields getting back up to what they used to be decades ago?
And John, breaking news, and this is just a tea leaf, folks, and the idea of a new rate regime. John, you see the Central Bank of Romania, the numbers don't matter, but the answer is they go up in rate.
From 2 to 225, and with the exception of Turkey, that's the direction of travel for global rates for most central banks.
Yeah.
And to Lisa's point on the rates market, negative real yields is part of the issue for the likes of Bill Dudley. Because they're so deeply negative in real terms, it means they've got more work to do. If you believe the Fed needs to do something about inflation, then they need to get to a positive real rate, Tom. And they need to get there quicker. And I want to be clear about the words of Bill Dudley. He's been calling for this, Tom, for the last 6 months plus. I remember talking to him going into the summer, and he raised this as a key risk. When the Fed had to move, they're going to have to move sooner and quicker and take it to a place that people aren't thinking about. And, Tom, they're still not thinking about it. That is an outlier call that the Fed's run rate gets anywhere near 3-4%. Most people, somewhere between 2 and 250.
On radio and TV, we need a data check to start. John, I'm going to note VIX 19 level just breaches 21, showing some of that morning tension. John, what do you see in the data?
The Nasdaq 100 breaking down a couple of hundred points, Tom. We're down more than 1%, negative 1.25%. Call it negative 1.26. In the bond market, yields did breach on 10s, 180 briefly, came back to 176.74. But the fact of the matter is we've taken out last year's highs. We've done it really quickly. Started the year at 150, Tom. Had a 25 basis point move last week and last week alone.
It will be interesting to see. We start strong this hour. Again, Francisco Blanch scheduled to be with us. RJ Gallo joins us right now with Federated Hermes. RJ, you're in the fixed income space. Are you steeled for a bear market, price down, yield up in your world?
Yes, Tom, we are. We've been short duration for well over a year to significant degrees. We felt that the simple fact of the matter was that the inflation was too hot for the Fed's transitory argument. That argument has now largely ended. The Fed has done a significantly hawkish pivot. We now have ex-FOMC members on your show talking about how hawkish they're going to have to be and where, in fact, the Fed might have gone wrong.
3 to 4%, the range that Bill Dudley's talking about, RJ. I just wonder, your response to that, you heard it, your reaction.
Pretty striking. As you just mentioned, it's well beyond consensus. I think it's hard to fully know. I think the Fed might have made an error in the fundamental change in their framework in the midst of a hurricane. When they went to flexible average inflation targeting, which was inherently dovish, the world was facing greater uncertainty around public health than in 100 years. And when you think about the inflation dynamic, the emergence or the evolution of that public health crisis has really driven the inflation dynamic at the same time the Fed was trying to boost inflation as well. Maybe the history books will look back and say that was the big mistake. There's time for that to unfold. We'll see where we go now. 3 or 4% sounds really high. It's quite possible that with so much debt to GDP in the U.S. at the federal level over 100%, it won't take as much hiking as it would have 10 or 15 years ago. It's hard to really be. Upward is the trajectory. Bearishness in high-quality bonds is warranted.
But, RJ, this is why it's so difficult and complex this year, isn't it? You've got the likes of Bill Dudley saying Fed funds a range of 3 to 4%. Others, like you, pointing out that if we hit 1.5, maybe there's enough tension in this market to cause a bit of a problem. RJ, how on earth do you come up with a forecast then for 22 with that in mind?
No, I think it's very difficult. All forecasts have confidence intervals. They're unusually wide at this point in time. I think from a directional standpoint, higher Treasury yields, eventually tighter financial conditions. The minutes were as hawkish as they could have been, in my opinion. When you consider that the Fed's FOMC members are now talking about balance sheet reduction in order to prevent the curve from flattening or inverting, you're talking about yet another innovation in the Fed's thinking. QE was never about trying to target the precise slope of the yield curve. It wasn't about that at all. And now they're thinking about the evolution of their different levers and the objectives that they can try to hit by moving those levers. And they're obviously hawkish objectives. I think the financial conditions do need to cooperate. The Fed is worried about inflation, feels like they might have lost control of it. And now they have to think about the different levers they can push and pull to try to manage that, and balance sheet reduction is clearly on the table.
What you just said, RJ, financial markets have to cooperate. Does that cooperate mean another taper tantrum, or put another way, to Bill Dudley's point, is the Fed put dead?
The Fed puts probably quite a bit further out of the money than historically it has been. I think the Fed probably, they're not looking to tank markets, but they are certainly looking, and they always do, monitor the provision of capital and the price of that capital in the economy. And at this point, they need those variables to ratchet back a little bit. It's hard to do so artfully without potentially causing a disruption, but that doesn't prevent them from attempting to have a softer landing in financial conditions. Right now, they're too stimulative, and the economy, especially inflation, is too hot.
I'm just looking right now at credit markets, which typically have been one of the tools of transmission of Fed policy. And I'm looking at yields on investment-grade bonds of about 2.5%, a little bit north of that. They've come up quite a bit, but still so far below what people think the end rate for inflation may be. What kind of credit disruption are you expecting if the Fed does pursue a much more hawkish policy?
The risk of a disruption is obviously accelerated. The simple fact of the matter is fundamentals remain strong. Corporate earnings are great. Leverage statistics look very strong. Default rates are minuscule. All the ingredients would suggest stay positive on credit. As a firm, we have dialed back some of our overweight credit bets, both investment grade and high yield. Still somewhat optimistic on the high yield front. Again, I think the Fed is sort of walking a tightrope to some degree. They need to talk tough to help control inflation expectations, step one. They have to hope or try to engineer a situation where that talking tough and then ultimately tightening do not, that we should be skeptical that we will be able to do so without some increased market volatility, with the prospect of tantrum-like behaviors at certain points. Now, that tantrum could be in rates. That tantrum could actually be in risk assets. back in 2013, risk assets did very well while rates spiked. It doesn't have to be a rerun of that. It's quite possible that the debt picture, there's a lot of debt out there, might mean that the restraint imparted on the economy by basis points of tightening is greater now than then, and risk assets become the lever to watch, sort of like 2018, when the Fed was tightening and the stock market finally sort of cried uncle and fell 20%, I think it was, in the fourth quarter of 2018.
December 2018 was a messy one. RJ Gallo of Federated Hermes. RJ, thank you. If you're just tuning in on TV and radio, moments ago we caught up with the former New York Fed President, Bill Dudley. He says the Federal Reserve needs to get a lot more hawkish. I have news for those who think the US Federal Reserve has turned more hawkish on inflation. Lisa, it has only just begun. The world's a bit Bill Dudley.
Yeah, he basically saying they need to do a lot more work and that there is not the Fed put that many people are expecting. And what we've heard is a number of different strategists saying they expect the Fed to step in perhaps after a bigger sell-off than people are comfortable with. But will they step in at all, especially if the markets are as resilient as they have been, John?
It can't remain in the fantasy land of its dovish forecasts indefinitely. Tom, some really powerful words from Bill Dudley this morning.
I think that's a key point, John. I've never seen a note like this from a former officer of the Federal Reserve. It's not scathing, that's the wrong word. It's a forceful note, John, and direct.
A bit of news on the tennis star Novak Djokovic as well.
Thank you.
Djokovic released. He was training on the tennis court. This according to his brother.
Thank you.
For people who've been following that closely, Lisa, I know you have.
I know.
I know Tom is doing something else right now.
Playing Wordle.
Playing Wordle.
No, come on. Anne-Marie won. The word was Pharaoh. She got it. She nailed it.
From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Formal talks between the West and Russia began in Geneva today. Vladimir Putin is demanding binding security guarantees against NATO. Meanwhile, the potential for a Russian invasion of Ukraine is persuading the US and Europe to focus on long-standing complaints they have dismissed for years. The US is pushing its allies to consider stronger sanctions on Russia. Goldman Sachs is forecasting that the Federal Reserve will probably raise interest rates 4 times this year. A research note also says the central bank will start its balance sheet runoff in July, if not earlier. In its December meeting minutes, Fed officials signaled they are preparing to move quicker than last time they tightened monetary policy. Omicron has flared in a port city that borders Beijing, and it did spread inland before Chinese officials detected it. That brings the variant to the doorstep of the capital less than a month before the Winter Olympics begin. Officials in the city of Tianjin have told its 14 million residents not to leave town unless it is essential. A big takeover today in the video game industry. Take-Two Interactive has agreed to buy Zynga in cash in a stock deal valued at about $12.7 billion. That represents a 64% premium to Zynga's closing price on Friday. Take-Two is behind the popular Grand Theft Auto series. Zynga is best known for Farmville games. I do love those. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
TV and radio, live from New York City for our audience worldwide. This is Bloomberg Surveillance with Tom Keene, Lisa Bravitz and Jonathan Ferro. We're down 30 on the S&P, down, let's call it 0.7%. The big movers in the NASDAQ 100 down 195, call it 196 now, down 1.25%. Crude comes in just a little bit, down 0.5% to 78.51 on WTI. The team here at Bloomberg, Tom, writing up this one on the hedge fund manager, Pierre Underand, an 87% gain in 2021 for his hedge fund, Tom. Just unreal.
It really speaks to when you get it right. And, leverage comes into it. I get that as well. We have to forget within the gloom, John, of active management, and frankly, the gloom of hedge fund underperformance, there's some huge winners.
One of his funds, at least one of his funds, Tom, just unreal after the move we saw in crude last year.
Yeah.
And the move we saw in crude last year is part of the inflation story, not all of it, but part of it, particularly the energy story in Europe, and that's complicating matters for central banks and policymakers the world over.
It's complicating it, but it takes complicated analysis, and someone that can do that is Francisco Blanch, Global Commodities Head of Bank of America. We're going to focus here on what you want to know, which is the price of a barrel of oil, but Francisco Blanch takes it down to the micro theory of companies, mines, production worldwide. Francisco, let me start there and save the glory for Lisa and John on $120 Brent crude. What do smelters do at aluminum plants? Given the Francisco Blanch call, what is an aluminum producer supposed to do?
Hey, Tom, thanks for having me. An aluminum producer is supposed to be, particularly in China, paring back supplies. And what we are seeing now, and we've seen now for some time, is the fact that the Chinese government is very focused on curtailing the energy intensity of its exports. Remember that for the longest time, we've all lived with, for 25 years or so, we've lived with incredibly cheap Chinese exports, which were driven by cheap labor, cheap capital, but also, many people forget about this point, cheap energy. And I think the Chinese government is increasingly focused on climate change and also focused on turning around its energy economy, which in turn, of course, as you just pointed out, is impacting the price of aluminum quite severely. And we're bullish aluminum this year. We think it's going to continue to go up. And part of it largely is driven by the increased energy costs. So as a smelter, particularly here in China, you're supposed to pare back your production, but the same thing goes for Europe. And ultimately, aluminum and many other energy-intensive commodities are heading towards North America, which is the world's energy haven from a cost standpoint.
Francisco, you came out with a pretty stunning call earlier last year about 120 barrels for crude, the potential for that increase. And we've seen at that time oil prices were climbing very significantly. Since then, people have cooled it a little bit. Do you still think that that is the pace of travel? That's the end point here, based on the increased production from OPEC Plus and based on the fact that we do have this Omicron kink that is reducing demand, at least temporarily?
Well, so Omicron is definitely impacting demand in the first quarter, but we've seen cases peak in South Africa and roll down pretty meaningfully. I think a lot of medical experts, a lot of people in the field are calling for a peak in Omicron cases in Europe and the U.S. within the next month. Big question mark in terms of our call is what happens in China and whether the Chinese government can maintain the zero COVID tolerance policy, which is, of course, leading to lockdowns in different cities with something as contagious as Omicron. So that's, I think, the biggest question mark around our call. But we still think triple-digit oil is within the works heading into the second quarter. We see demand recovering quite meaningfully. And one thing we've been noting for a while is that OPEC Plus supply, is likely going to start leveling off in the next 2 months. Remember, a lot of Russian companies have not been able to meet their export quotas, and Rosneft has been kind of left as the main supplier of incremental barrels. But even then, we think Russia's incremental supply will level off naturally within a month or so. And then it's really just down to Saudi Arabia and Emirates to produce incremental barrels for the world markets. It's going to be a tight 2022 if demand recovers here.
Francisco, there's so much in there that I want to unpack, but I want to start with the China and the zero COVID policy. Right. Can you give us a sense of the bifurcated outcomes to your call, depending on whether they try to stick with it or whether they give it up and try to adapt to a more open type of policy?
Right. Well, again, I mean, I think the big question mark here for everybody is what happens in the Winter Olympics. We are a month away, and many people, me included, which are not necessarily experts, but really question how you can run a zero COVID tolerance policy under this influx of athletes from all around the world and diplomats and kind of everything that the Olympics brings with it. So I think assuming that there is some relaxation of the policy, we'll see continued growth in demand. But remember, China is 15.5 million barrels a day in a 100 million barrel a day market, is the second largest consumer in the world. It's the #1 oil importer in the world. So obviously a strict lockdown in China broad-based will lead to meaningful demand loss. So we're keeping a close eye, and that's the main risk to our view at this point. We think Iran, which is the supply risk, is less of a challenge, given it seems like a resolution to the Iran nuke standoff is looking less likely by the day.
Right.
But those are two main downside risks to our view.
Francisco, forget about all the Wall Street chit-chat. What does triple-digit oil, triple-digit aluminum, triple-digit live cattle, what does all that mean to us out in the real world? How's our world going to change with a Francisco Blanche $120 a barrel oil?
Well, what's going to change, and you guys have talked about it in the prior segment, is going to force the Fed to tighten policy a little faster than the market was anticipating. I think 4 hikes this year is pretty much baked in, so we're going to see that. I'm a little more worried about the balance sheet runoff, partly because what we saw back in 2018. In fact, back in the day, we wrote extensively about this in our cross-asset publications, and we looked at the impact of that on pieces entitled, one of them is entitled Mind the Unwind. And I do believe that that the Fed balance sheet has a huge impact on just generally asset values, maybe less so in commodity values, but we still saw a big sell-off in commodity prices as the Fed started to compress its balance sheet in the second half of 2018. So I think that's what it means. It means the Fed's going to be having to press a little harder on the brakes. And of course, we know that the big forces of demographics and technology could come into play in a minute. So it's a difficult job for the Fed to slow down the economy, to bring inflation back down to 2%. They could overdo it, and that's, I think, the big risk we're looking at into the second half of 22 and I guess first half of 23. That's what everyone's got in mind here as we go over the next 6 months.
Francisco, can you give us a sense of the pace of that increase to triple-digit oil and what the trigger could be?
Right, so the trigger is going to be primarily a competition between gasoline and middle distillates, things like diesel and jet fuel, that refineries need to produce. So generally, when you have two big forces in the oil market, the driving and trucking and flying, coming together and clashing, right, with this backdrop of incredibly high global gas prices, creating substitution into oil. That could, I think, be the trigger from a demand standpoint. Refineries really trying to catch up and produce both products. And remember, the incremental barrels that Saudi Arabia can bring into the market are going to be heavy and sour. I'm not going to get too technical here, but heavier and sour barrels are harder to refine. So refiners are going to have to work twice as hard to bring the gasoline and the jet diesel the market wants, but at the same time, they're going to have to do that with incrementally heavier barrels that are harder to refine. And that's a little bit what we saw back in 2008, and that's one of the reasons we remain quite bullish on oil heading into the summer months here. Plus, there is a big pent-up demand story. I think we all want to travel and move around and see friends and family and visit places. So the pent-up recovery in services, I think, is going to be quite spectacular once the Omicron wave fades, and of course, assuming there's no third or fourth or fifth transformation of the virus here.
Francisco, just quickly, you mentioned the back end of 2018. I think a lot of people would have sat up when they heard that, because we went from 73 down to 45 in Q4 of 2018. Right. It was a big downdraft. It feels different this time when I look at the screens. Everyday yields are up and equities are suffering. Crude's pretty good. It's resilient. Can you walk me through the different dynamic now compared to, say, back in the back end of 2018?
Right. So I think it's different. Interest rate hikes are different than balance sheet compression. Interest rate hikes do not tend to slow commodities down in the early stages, and we've seen that repeatedly. Commodities are late cycle performers. Inventories right now are very low for crude oil and for many other raw materials. So what tends to happen in Fed tightening cycles is the first few hikes are less impactful, and then as you get towards the end of the hiking cycle, that's when things tend to roll off. And that's what we saw the last time as well, right? So the second half of 18 was kind of the end of the Fed tightening cycle, if you like, and that's what we expect this time around, except for the Fed seems to be trying to accelerate everything a little more than they did back then. Back then, they were very gently hiking rates. Now things could happen a lot quicker. So we do expect a lot of volatility in 2022, and I think that's true for all markets, not just commodities. I think it's true for equities. It's true for fixed income assets. We're going to see a fair amount of vol. And I say that as part of my role in the derivatives business, but the research business. But, so we do think volatility is going to be extremely high this year compared to other years.
Francisco, thank you. As always, Francisco Blanch there of Bank of America. Tom, with that triple-digit crude call for later this year.
It's a foundational call. We're seeing this from many other houses as well. I really want to point out, folks, that even though we've had not a gloom discussion today, but certainly led by Bill Dudley's comments, the idea of a higher interest rate regime, John, there's some people really pushing against that, including Deutsche Bank on oil.
The conversation continues right here on Bloomberg Surveillance. Coming up shortly, Albert Bourla, the chairman and CEO of Pfizer, that company announcing a series of research collaborations this morning. We'll get our teeth into that. And the latest with the vaccine effort. Futures down 28 on the S&P. We're down 176 on the Nasdaq, down more than 1 full percentage point on the Nasdaq 100. From New York, this is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap between people that were worried about climate and people that were taking action.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Said this last week, I'll say it again. What a start to the week in financial markets. Mike McKee heard what Bill Dudley had to say on this program 30 minutes ago. The jacket's on. He's racing into the studio to get mic'd up to talk about it. So ahead of Mike McKee, let's whip through this price action. Down 28 on the S&P. We're down 0.6%. On the NASDAQ 100, down 178. We're down by more than 1 full percentage point, negative 1.14%. In the bond market, a bit more exciting a little bit earlier on with yields through 180 briefly. Back down to 177.63 on 10s right now, up by more than a basis point. But, you know, we've got to start the conversation with where we took it 30 minutes ago. To see the former Fed officials talking the way they're talking right now is just something else. This from Bloomberg Opinion and Bill Dudley, the former New York Fed president. The Federal Reserve needs to get a lot more hawkish. It can't remain in the fantasy land of its dovish forecasts indefinitely. He's talking about a Fed funds rate range of 3 to 4%. 3 to 4% is not part of the conversation on Wall Street right now, Tom.
Yeah, it's going to be interesting to see. And I mean, every corporation is going to adapt to this. Just no question about it. John?
And one of those companies that needs to adapt to the world around us, it's Pfizer. And Albert Bourla, the chairman and CEO of Pfizer, I'm pleased to say, joins us now. Dr. Fantastic to catch up with you, sir. A series of announcements from your company, led by the 4-year research collaboration with Beam Therapeutics, expanding the mRNA effort here. It's pretty clear to see. I want to understand, though, my first instinct, seeing the news, why the partnerships instead of straight acquisitions?
I think sometimes being a good partner provides better results than if you own a company. And right now we want to place multiple bets and collaborations. And we have proven that this works very well with BioNTech. So I don't say that you would not see also acquisitions from our side in this front. But right now, in these specific areas, we felt that partnerships will give us exactly what we want without dedicating amounts of capital that would be needed if we wanted to acquire the companies.
Well, that's what I wanted to ask. That's what I wanted to go to next. What does that mean for capital allocation elsewhere? What kind of doors does it open up if the strategy elsewhere is a series of bets and a series of partnerships?
Clearly, this is one of the top priorities that Pfizer and myself personally are having for this year. I wouldn't say it's the number one, because the number one, it is to stay ahead of the virus, to stay ahead of COVID. This is what the company needs to do because this is what the world needs. But clearly, number two priority, it is to invest a lot of capital that it is accumulated, either through the normal course of business or through COVID. And that needs to be an investment on science. We believe that we have the machine right now, the clinical development machine, the manufacturing machine, the commercial machines. All these platforms are waiting for new science, highly breakthrough science, to come in and produce solutions for humankind. And this is where the capital will go.
Well, let's talk about the platform getting the most attention right now, mRNA. It's been met with hope, confusion, and to some degree, skepticism. Doctor, I'm trying to understand from your standpoint how you communicate to people the hope around this when we keep getting told we need another shot. If it's so good, why do I need a second, a third, and a fourth?
Yes. First of all, let me say what I think about mRNA. mRNA is not the holy grail, but it is a very, very powerful technology. It is a very powerful technology that has produced dramatic results, positive impact, and we are only scratching the surface. So our strategy and our vision, it is to harness the power of this technology to multiple other areas. The first area that is the self-evidence and the lowest hanging fruit, it is other vaccines of other infectious diseases. And this is something that we are doing mainly in partnership with BioNTech. We just expanded to a third target. You said why, if it is not good, is not producing longer lasting results. It's not something that's related with mRNA, it's something related with the virus. As you most probably know, or if you ask experts, the natural infection with this virus also doesn't produce big immunity. In fact, the natural infection in many times it produces half the time that you can get in terms of how long you're protected than the vaccines. So it's not right to say that the mRNA doesn't create durable protection. It is this virus that is very difficult to tackle and mutates constantly. That's why we are happy that we have mRNA. But it's not the only area that mRNA can help. Cancer, it is another area, and we are having significant efforts right now in the world and internally. And another area that we announced today, a partnership with BIM, are the rare diseases. These are diseases mainly that they have as a cause a mistake in your DNA. It's a genetic mistake. Something is wrong with your DNA, and as a result, you have a disease. What we try to do with the base gene editing technology, which BIM is a master, it is to produce targets that will be delivered through mRNA that will be able to correct this mistake. There are several gene editing technologies. We did a lot of due diligence, and we thought that the base, this is how it's called, the technology base, is the best. And also did a lot of due diligence about companies, and the best one was BIM. And this is why we did this partnership. We are having some other deals that we announced today that will help us to improve even further. The Acuitas, which is give us license for 10 different targets in the LNP target. LNP, it is the lipid nanoparticles that are used to transfer the RNA. And the last but not least, it is the codex. What codex technology is all about? They are creating DNA instead of biological manufacturing, which means that you have virus to make it. It's a synthetic. Bottom line, what does this mean? Instead of having a process that takes a very important process for the production of our mRNA vaccine, instead of 1 month, you can take it down to a couple of days. This is very, very important because imagine, for example, you can have a new variant right now, if we were successful theoretically, instead of creating a new variant vaccine in 90 days, 100 days, to do it in 2 months rather than 3 months. Instead of being able to create a flu vaccine that you are 6 months or 5 months ahead of the target, now you are 3 or 4 months before the season, and you have a better match. Very important technology that will allow us to solidify our leadership in this area, and more importantly, to deliver to the world what they're expecting from us. Better healthcare solutions based on this technology.
Doctor, you're running down the clock, so I've got to jump in. I apologise. This from Novak Djokovic in the last couple of moments, a story I'm sure that you've been following. I'm pleased and grateful that the judge overturned my visa cancellation despite all that has happened. I want to stay and try to compete in the Australian Open. As you know, Doctor, he got that exemption by having a previous infection. You said something quite important. I want to understand from your standpoint whether a previous infection provides similar protection equivalent to a vaccine.
First of all, I'm a fan of Djokovic, but I can't even go to this dispute if he has the documentation or not. This is something between him and the authorities and their doctors, so that's it. I think previous infections, they are, in general, not in this case, in general, they are protecting against reinfections for a period of time, the same like vaccines. The comment that I made was that, for example, in a lot of European countries, the validity of the certificate of vaccination is 6 months after your last dose. For natural infection, it's go to 3 months or 4, because they know that the protection that you are getting after natural infection doesn't last as much as with the vaccine.
Introducing Finico Bank, the new platform for serious online trading. With 20 years experience, professional tools and low fees, Finico is the solid, reliable bank of choice for traders who accept no compromise. Open your account today at finicobank.co.uk.
100% own the process, and we don't have any royalties of size or sizable royalties to provide to any people. So we are having 100% of the economics, and the production margins are bigger in pills rather than in this vaccine.
Final question from me, and it's a sensitive one. You've set up a strong stream of recurring revenue now with this vaccine rollout. You're being insulated by government policy the world over. Do you worry sometimes, Doctor, about the PR fallout from that, the backlash that you could get, making money off a vaccine that's now been mandated in many, many places, being insulated, having that revenue stream largely insulated by governments around the world? Do you worry about the fallout from that?
Although I'm not sure I understand the word insulated, but I think I understand the meaning of your, the meaning of the insulated. But I understand, I think, the overall concept. No, I feel very, very, very good. If you have the belief that it is appropriate for private sector to be entrepreneurs and produce, let's say, products, medicines that they can get some profit out, I couldn't think of a company that would deserve more to make money other than a company that did so good to humanity. I'm very proud and for what we have done, and I'm very, very enthusiastic that this example will create way more risk-taking in this industry, the healthcare industry, that will result in way more breakthrough products that will save way more lives.
Doctor, a ton of issues that you and I need to cover in the future. We appreciate your time this morning, though. Thank you very much, sir. Albert Bourla there, the Pfizer CEO. Tom Keene on just some of the big issues right now in his world.
Yeah, there's some big issues in his world, and what it's about is they're making it up as they go. We're always, what's the next variant, John? I mean, Omicron at some point is going to fade away, and I guess there's another variant.
And then maybe we need another shot. And the PR question at the end there, TK, you do feel that it's an uncomfortable situation for a lot of people.
That's true every time. I mean, this goes back, at least to World War II in every other disease. And it's something they'll manage forward. I'm really curious, John, about what you did not address, which is about the new Pfizer versus the Pfizer of old and, how he's going to lead the company forward over the next 5 years.
Next time, TK. Tom Keene, Lisa Braverton, Jonathan Ferro. Futures down 26 on the S&P. We're down 0.5%. On the Nasdaq 100, down 167, down a little more than 1 full percentage point. Yields breaching 180 briefly. A ton to talk about this morning with Stuart Kaiser of UBS. We'll do that a little bit later in about 20 minutes' time on Bloomberg TV. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Inflation in the US has probably hit the fastest pace in 4 decades. The Consumer Price Index comes out on Wednesday, and it is forecast to rise 7% for the year through December. That helps explain a shift in the Federal Reserve's approach to monetary policy, along with more consumer anxiety about the economy. Now, in Kazakhstan, security forces backed by Russian-led troops are restoring control after crushing demonstrations. The government says almost 6,000 people have been detained. According to state TV, 164 people were killed. The real number is thought to be far higher. Now, Novak Djokovic says he's grateful a judge overturned the decision to cancel his visa ahead of the Australian Open tennis. The defending champion has posted a picture of himself on court in Melbourne on Twitter and insists he's determined to stay and compete. Australia's immigration minister is considering whether to revoke his visa yet again. Djokovic believes he has a medical exemption despite not being vaccinated against COVID-19. The parent of Facebook is going bigger in Texas. Meta Platforms has leased half of what will be the biggest skyscraper in the city of Austin. The company has 2,000 employees in Austin and is seeking to hire 400 more. Both Samsung and Tesla have recently announced plans to expand in the very same area. The new CEO of Ferrari is trying to put the iconic Italian automaker on track for electrification. Benedetto Vegna is revamping the company structure and hiring managers with a technology background. Ferrari has also been slow to embrace batteries. Its fully electric car isn't scheduled to debut until 2025. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
That has a very benign forecast relative to what's actually happening on inflation. If you look at their forecast that they published at the December FOMC meeting, they have inflation melting away to 2.1% in 2024, even though they don't take monetary policy to a tight setting. The end of 2024, the federal funds rate is 2.1% below what they think is neutral. So how does the inflation magically disappear?
William Dudley, the former president of the New York Fed, with a really must-read for Global Wall Street essay today for Bloomberg Opinion. A very forceful note, rates higher, and more persistently higher, maybe starting out slow, but then really getting to it. And all of that, of course, devolves down to what you're going to do with your marginal paycheck. Marty Berger's expert at this, the chief executive officer of Silverstein Properties, one of the great landlords of New York City. Marty, I'm going to cut to the chase because I did the Silverstein Properties math. I went to given property, 116 John Street. There are 416 units. There's 2 vacancies. How much are rents going to go up this year when the math is there's 414 apartments rented and only 2 empty?
Well, it's a great question, Tom. Thanks for having me on. You know, we just purchased this property the end of December, and it was 99% occupied. So obviously we're hoping to see rental growth, and New York City is really on a comeback. We have a larger portfolio in New York City, a couple thousand units, and that whole portfolio went down to 68% occupancy when we were usually in the 98% range. And then that whole portfolio came back quickly.
Right.
So
Yeah. Okay, well, that's great. Lisa from the Upper West Side emails in and says, Marty, you didn't answer Tom's question. Are rents going to go up like a normal rate, 2, 3, 4%? Or help Lisa out here. Are we going to see 10% rate increases?
I think rates already did go up a lot, and I think they'll continue to rise. I don't know if they'll spike as much as they did.
Marty, what about in the office space? I mean, we're talking right now with people who are coming back into the city, but we still, I mean, we're in Midtown here, and you can see all of the empty storefronts. Are you still optimistic that you're going to see all of those offices actually filled, or are they going to get repurposed into condos as well?
Well, I don't think you'll see as much offices being repurposed as you know, into different things like that. But offices will come back. People will occupy the offices. I think it's slow to come back because of all the different variants, but you'll see people back in the offices. We started to see them come back in October and November. The Delta variant had slowed it down, and then it started to pick up again. Omicron is slowing it down again, but I think in the middle of this year, you'll see it pick up again.
Marty, one theme of New York City has been that it has rebuilt itself again and again, both figuratively as well as literally, with new development projects. I wonder, though, given the Omicron variant, given how much the pandemic has rejiggered people's notions of work and play, are you still planning on building 2 WTC, that World Trade Tower that you've been holding off on?
Yes, we will definitely be building 2 World Trade Center, and the market definitely will demand it. We're seeing higher rents downtown. We're actually hitting $125 a foot now, which is a number that was unheard of. And our 3 World Trade Center building is almost completely filled now, and that was the last of the new buildings to be built downtown. So we're very happy with the energy and the demand that's going on downtown.
Marty, there's been this huge shift in the meantime, though, to suburbia and also to other smaller cities and, frankly, to Florida. How much does that have legs, or do you feel like that trend has been peaking as people realize that they miss their old lives?
Well, the corporations want to be where the talent is, and the talent wants to be in big cities. So I think you'll see all the corporations flock back to the cities, and that's why we haven't seen any major users give back tons of space. I think people will be using the space differently, but I think that they'll still be using a lot of space. And I think all of the talent which wants to be in the cities, because that's where all the services are, that's where all the arts are, that's where all the amenities are and the entertainment, I think they'll continue to thrive, and I think the office space will continue to be built.
Marty, you've been on both sides of the real estate world and gathering funds, bringing them in, for example, at Goldman Sachs, and now on operations and investment at Silverstein Properties. Give us a window into the effect of the big tech companies. Today's headline is Facebook down in Austin buying, I don't know if that's your unit, but buying zillions. I think the square footage is about the size of Rhode Island. But Marty, help me here with the big tech companies and how they've changed your world and, frankly, our world.
Well, it's interesting. Tech companies coming to New York didn't want to be in glass and steel, and now they're in glass and steel. So it's very interesting to see that, because we've got Uber and Spotify in 3 World Trade Center and 4 World Trade Centers, respectively. But the tech companies need to be everywhere. They need to find that talent. And they can't just go to Austin and find 7,000 people, because there aren't 7,000 new people to find in Austin, even though there are people moving to Austin every day. So they need to go to the bigger markets, too. That's why you'll see Facebook and other very large tech companies expanding in the larger markets like San Francisco and New York and Boston and Chicago. And so you'll continue to see tech thrive in bigger cities.
Marty, throughout this show, we have been talking about the new rate regime that we're heading into, that the Fed is going to be forced to be much more hawkish and raise rates more significantly, with Bill Dudley, former New York Fed president, coming out and saying the Fed funds rate should probably peak out around 3 to 4%, and they have to move quickly. What would that do to your property world?
Well, look, we spent the last 2 years refinancing a lot of our properties. We did over $5 billion refinancing, assuming this was going to go up. But with the rise of rates, we'll also have the rise of rents. So when we're underwriting, we're also assuming that rents are going to go up, because that's what's happening with inflation.
Marty Berger, thank you so much. With Silverstein Properties, a window there into, yes, residential, but also commercial real estate. this morning. Lisa, I would suggest an adjustment in the market over the last 60 minutes.
Yeah, you've seen a deterioration, certainly, as people start to try to understand what it means for the Fed put not to necessarily be there, at least not as quickly as it has in the past, and a new rate regime. I mean, the number of strategists rejiggering their calls for faster rate hikes is really shocking to me, Tom.
And we see it with the VIX, folks. That's the metric I'm using. You go out to 19 to a higher number, more fear, more angst in the market. And we get out over 20 level 2 hours ago, now 21.04 on the VIX. Not a big number, but nevertheless, the migration there from the 16, 17 level, substantial. What do you think of the comments from Mr. Berger? I don't buy for a minute. You know, they're supposed to say measured real estate rental raises baloney.
Well, I think that there is no doubt that one of the reasons why people are worried about inflation is because of the rents that lag behind some of the prices that we have seen on housing. That is going to increase. You're going to see rents continue to increase, and that's probably one of the reasons why the Fed would actually like to cool that market, right? So what is the consequence?
How are they going to cool it? Come on. How do they cool it?
Well, that's it. I mean, if they make it more expensive to borrow, people won't be as willing to spend as much. They won't be able to take out mortgages as cheaply. And then you could potentially get, that trickle out into eventually a dampening in how much rents rise. How quickly can they do that, though? And that's just one component in a multifaceted picture where you see, wages rising, et cetera. Pretty broad-based.
Whether it's the boom in Los Angeles from all that streaming money or in New York City, I mean, what I heard from Mr. Berger there is the resiliency of the city experiment, and for that matter, that goes worldwide as well. Please stay with us through this day with the market. You got to stay with us with the market. NASDAQ down 1.3%. This is Bloomberg on radio, on television. Good morning.
Him and his brother lived quite close to us when we used to live in Manchester. Kim Jong-un. Yeah. And
energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story. How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The second trading week of 2022 from New York City for our audience worldwide. Good morning, good morning. Futures on the NASDAQ deeply negative again, down more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. Pricing in more hikes for 22.
4 rate hikes.
4 rate hikes.
4 rate hikes on the table.
All these changes on rate hike views.
The March meeting is very much live now.
The March rate hike is definitely a go.
If the Fed raises rates 4 times.
You're getting tapering, you're getting rate hikes and potentially balance sheet runoff.
That all in the space of 12 months is a considerable change to the monetary stance.
Unfortunately, the Fed is having to hurry up because it was late starting.
The difference this time is the role of the balance sheet.
The shrinking of the balance sheet. Transition from QE to possibly to QT.
The Fed cannot escape the inflation issue.
You could check that employment box.
We're inching very close to full employment.
Now it's all about the other mandate. It's all about inflation.
They have a significant inflation problem on their hands.
And they are going to chase this thing, and they are going to hike pretty aggressively.
Joining us now, Stuart Kaiser of UBS, Victoria Green of G Squared, and Morgan Stanley's Michael Kushner. Victoria, I want to start with just base case expectations for the Fed this year going into next. What are they now?
4 rate hikes. I agree with Goldman. I think they've got to hurry up. They hit that magical 4% number on unemployment. It came in right at 3.9. So I think that's the green light for hikes. I think the market finally woke up. You know, we got those meetings in late December, but I think a lot of people were actually out on holiday. And so finally this year, you're seeing the market react. Okay, it really is hawkish. The Fed really is going to do this. Short of a really disastrous number or something terrible happening with the virus, I think it's all full speed ahead.
Futures down again on the S&P, down by 0.7%. On the NASDAQ 100, down 190, down 1.2%. Stuart Kaiser, your response, please.
Hey, Jonathan, good morning. Our view is they will hike in March. Our house view, though, is you get a pretty strong deceleration in inflation in the second half of the year. That might give the Fed, a little bit more room to slow down at that point. I mean, I think what you're seeing from a markets perspective is last year, the equity markets in particular tolerated a level of inflation that historically they would not have. And what allowed them to do that was deeply negative real rates and an upward sloping real rate yield curve. The Fed turning hawkish has changed that. And now you're getting, real rates have moved aggressively higher. And if you get the flattening in the real yield curve that we expect, that becomes an issue for equity valuation. So I think what you're seeing now is not only the market adjusting to the Fed stance, but maybe playing a little bit of catch up on inflation in terms of what they tolerated last year.
And adjusted to two things too, not just rate hikes, the prospect of them maybe for this year, as Victoria pointed out, but also balance sheet reduction. There was one line of the Goldman call that jumped out to me. With inflation probably still far above target at that point, as we get to the back end of this year, we no longer think that the start to runoff will substitute for a quarterly rate hike. We continue to see hikes in March, June, and September, and have now added a hike in December as well. And Michael Kushner, I wanted to come to you on that line from Goldman. We no longer think that the start of runoff will substitute for a quarterly rate hike. Can you walk me through the dance that you expect between balance sheet reduction and rate hikes?
Well, I think it's a very interesting dynamic, because one of the things that I think add a lot of uncertainty to what the impact of this change in Fed strategy is going to be is how much quantitative tightening runoff are they going to do, and what does that translate into rate hikes? So if there's $50 billion of balance sheet reduction equal 25 basis points, I'm not saying that's true, but suppose it's true, and they run off $100 billion next year in addition to tapering to zero, is that another 1-2 rate hikes on top of 4 rate hikes? Or are they going to be substituting quantitative tightening for rate hikes next year? In other words, are they going to try to balance the two in terms of its impact on the yield curve, on the impact on financial conditions. And that is still not clear exactly what they're going to do.
That's something I'm trying to work out too. Can you run me through the numbers you're looking at the moment, Michael? The amount of balance sheet reduction you'd be forecasting in the back half of this year into next year, and whether it is the equivalent of 1 or 2 rate hikes?
Our rule of thumb that we're using is something in the neighborhood of 50 billion, 75 billion equals 25 basis points of a rate change. So the question is, if they keep hiking rates and don't affect the balance sheet and global interest rates stay very low, are we just going to get a flattening and flattening and flattening of the U.S. yield curve with not enough tightening of financial conditions? On the other hand, maybe you substitute more aggressive quantitative tightening for rate hikes at some point in 2022, potentially steepening the yield curve and moving back in yields up relative to short-term yields, which may be a better combination. I think there was a hint of that in some of the Fed communications last week about juggling the two to try to get an optimal mix relative to their objectives, which in the bottom line is tightening financial conditions. The question is, how do we optimally do that in the global context we face right now?
Mike McKee has to tie this together for us. Let's get over to him. Morning, Mike.
Good morning, John. It is inflation week in the economic data world, and a lot of news is going to come down that will affect everybody on your panel's thinking. Of course, it is the week that Jay Powell goes before Congress for his nomination hearing, and we'll see what he has to say about it. But he's going to have to react to data that he hasn't seen yet. Wednesday, the CPI is expected to come in at 7%. Then we follow that on Thursday with PPI, and Friday import prices. Also Friday we get retail sales, which will tell us something about whether the Omicron variant is hurting the economy just a little bit, but any little additional information is useful. But the real news this week is going to come from the hawks who are speaking. I mentioned Jay Powell. He has his meeting on Tuesday, but also Tuesday, tomorrow. Mester, George, Bullard, they are all voters this year. They have all been traditionally hawks on inflation. You and I will be talking to Loretta Mester, and we will get their view on how quickly they need to do all of this, particularly the balance sheet reductions, if you're buying the idea that March is in. And we're going to have to ask him about this. The Fed and the CPI, it is expected to come in at 7% on Wednesday on a year-over-year basis. That would be the highest since 1982. You remember that, John. Mike, we had Ronald Reagan as president then, and Paul Volcker was the Fed chair. So we are looking at historic levels of inflation, and the question is this something new, a new kind of inflation because of the pandemic, or is this the beginning of a wage price spiral?
Mike McKee, I'll let that go. Mike, good to catch up. I'll catch up with you later. Thank you, sir. Bill Dudley making some headlines on Bloomberg Opinion this morning. Victoria Green, I just wanted to get you to respond to it if you can. The lead line from him is the Federal Reserve needs to get a lot more hawkish. He goes on to say, I have news for those who think the US Federal Reserve has turned more hawkish on inflation. It has only just begun. He's talking up a Fed funds rate, a range of 3 to 4% at the high end. Maybe that's where we top out. Victoria, how would you respond to those kind of comments?
Well, I do think they are going to have to get hawkish. I think the little bit we're seeing a replay of last year. Remember, when we started this year, there's almost this deja vu we're seeing that, okay, January started a little messy in the markets, but hey, we've got this virus snipped, everything's going to be moving forward, maybe the Fed hikes. And so I think we have a lot of wild cards that can happen over the next 12 to 24 months. But I don't think anything's different. I don't think anything's changed. I think they're going to keep hiking. I see 4 hikes this year, 3 next year, and the topping out around 3%. That typically is where the markets tend to roll over. If you look at what happened in 2018, that's finally when the market said, no, we're done. We can't take this anymore. You hit that 3% level. It's just too much. The cost of capital is too high. And that's really when 18 rolled over. So if you look back at the playbook, I really don't think this is going to be different. I think this is going to be a normal hiking cycle. I think you could see some wiggle room potentially on what happens with the virus. You know, for instance, Lululemon came out warning today that they're going to be on the low end of guidance. We'll have to see where the other retail sales come in, but we could see a little bit of a Q4 drag. I'm kind of hoping a little bit we shift more towards earnings from macro as we hit the end of this week, and we can start to see some of these fundamentals. You know, the Fed's going to be aggressive. Did think it was a little interesting. Powell sure did wait till he had his nomination in the bag before he started hiking. So not to be cynical, but I think this was a plan all along.
Hey, not at all. He was asked that in the news conference as well, and then he gave us a real-time insight into how he saw things playing out at the time, and he ummed and ahed a little bit too. Victoria, you came into this year and you said the risk reward in stocks was better than in bonds. Things have shifted already after week one. Is that still the case?
I mean, I told you so. Is that a good way to put it? I think I know that bonds. Look, bonds are bleeding out just as bad as stocks, and we've been a proponent of value, and that's where we want to be. And honestly, Russell 1000 value is up on the year versus the Nasdaq. You've got about a 500 basis point difference between growth and value right now. Again, this is a bit of a playbook of how we started last year. But if the Fed is hiking, I want to be in the right parts of the market that are going to benefit from a growing economy and are going to be able to withstand inflationary and labor pressures a little bit better. So we're looking at our cyclicals, we're looking at our large value. And I think some of this stuff with growth rolling over, the S&P 500 so heavily cap weighted to growth that, those 5 names rolling over, the FANGs of the world, is going to take the S&P 500 down with it versus the Russell 1000 value. And the Dow to some extent holding up better. I still like stocks over bonds. I think you're going to have hiccups like this week. I know we're looking at the 5th losing session in 5 trading days right now. But if you look on the fixed side, you also have a lot of fixed bleeding out, and it's been a very uncomfortable start of the year in fixed income, so I'd still take my chances with stocks. I just want to own the right stocks.
The 10-year yields have been rising for 7 straight days now, beyond the index, beneath the index. Stuart Kaiser, if I go to the financials, the banks are up 9 or 10% year to date, a week into this thing. You still like the banks here, Stu?
Yeah, I think we're generally in that direction. I think Victoria's point's the right one. It's a tricky kind of mix here where you have inflation accelerating and you're a little bit worried about the growth outlook if they start to tighten. And that kind of gives you a weird answer in terms of what you want to own. You kind of want to be in banks and the commodity sectors to get a hold of that higher rates and inflation picture, but you need to be a little bit cautious on the growth side. So I think people are kind of struggling with that balance. And, I think the other thing is, inflation is going to print 7%. That's our forecast, but we have it at 7.3% the next 2 months. And we don't have core CPI peaking probably till March. And if the peak is March, it could be April, May, June before the market's actually convinced that peak is in. So, not only is this an issue for today, but, this is a debate we're probably going to be having for the next 3 to 4 months.
Well, we're having it right now, so let's do it. To come to you, Michael Kushma, your 10-year yield right now just south of 180. Breached that level early this morning. Yields higher again by 3 or 4 basis points. I caught up with Mike Collins on Friday of PGIM. Michael, he said to me that there's value here on 10s, on 30s, and the Fed can only take it so far. Buy this, perhaps. What's your response to that?
It's a very good question, one we're debating actively right now because yields now are kind of only back to where they were in 10 years, back to where in March or September of this year, maybe a little bit higher now. And 30 years are still well below the highs that we saw last year. So yields are up, but they're not up as much as you might expect, considering how much inflation's moved clearly and how much the Fed has moved in response to this. And I think the global backdrop is constraining how much U.S. yields can rise, absent other dramatic changes in Fed policy like quantitative tightening, other measures to disturb the supply-demand balance. So I think right now we're not quite thinking there's value here, but I think there's limits to how high they can rise given the global constraints on what's happening and the fact that we have to keep in mind that PMIs look like they're rolling over, not collapsing, but they're on the downward trajectory. Inflation is peaking in Q1, but it's sticky. I think one of the things which has caught people by surprise is, and the emerging markets have given us a good indication of this, is that every month we get a positive inflation surprise. When was the last time any country anywhere has given us, wow, inflation this month has turned out lower than expected? Despite bearishness on inflation, it keeps going up. Yep. At some point, this will stop. And until it stops, I think yields will have this upward pressure.
Michael Kushma, Victoria Green, Stuart Kaiser sticking with us. Equity futures much lower on the NASDAQ again. Let's get across to Abby for more. Hey, Abby.
Hey there, John. Well, let's stick with this rotation out of growth and into the cyclicals because, of course, we do have that NASDAQ 100 down sharply, down more than 1%. This is everything to do with Apple and Microsoft. These were the 2 biggest point drags last week. Microsoft last week, John, down 6.6%. Its worst week since March of 2020. That's the degree of selling pressure as rates have backed up in an extraordinary way and on the prospect of the Fed tightening. On the other hand, take a look at the banks. You were mentioning last week the best week since 2020. Well, those banks up once again on the day, John.
Abby, thank you. Coming up on this program, the Omicron variant flaring up in China.
This is massive, not necessarily only on growth, but indeed on the ripple effect, on the bullwhip effect, which are trade and supply chain disruptions and inflation.
That conversation coming up next from New York City. This is Bloomberg.
When you think about schools in particular and children, where we've seen pediatric hospitalizations actually on the rise amid the spread of this variant, do you think keeping schools open is the right move?
If done well, school is a relatively safe environment for kids. Masking, tests, especially during the surge of cases, I think it is very important for kids to be in school, and I think the chance that school becomes an explosive source of new infections is low with precautions. 10
million cases in just a week. Are we reaching a peak of this wave, considering how quickly it is spreading through the population?
I think at a certain point it really has to slow down, and that's probably within a couple weeks or a few weeks away. And that's, I think, going to be good news. The question is, can we keep hospitalizations down enough during this period so we're not swamping hospitals?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Why, if it is not good, is not producing longer-lasting results? It's not something that's related with mRNA, it's something related with the virus. As you most probably know, or if you ask experts, the natural infection with this virus also doesn't produce big immunity. It's this virus that is very difficult to tackle and mutates constantly.
Omicron taking a toll on global economies with infection rates mounting. European officials considering tighter restrictions, while the US struggles with a surge in hospitalizations. For more, I want to bring in Sam Fazeli on Bloomberg Intelligence. He joins us now. Sam, can you walk me through the very, very different responses we're having to the same issues in a lot of places around the world?
Yeah, Jonathan, I think this is going back to the same problem we've had all along, the different rules in terms of travel, different rules in terms of what you need to get into a country versus another. So really, we haven't got round to using the massive expertise that's been built in across different regions to manage this on a global basis. And that's what we must move on to that as soon as possible.
Sam Fazeli of Bloomberg Intelligence. Thank you, Sam. Weighing in on a lot of this is Mohammed Al-Aaron of Bloomberg Opinion, wary of the divergence in global COVID policies. Here's what he had to say.
We are learning in a very non-uniform way to live with COVID, the dispersion in approaches. And that's an issue that we have to take into account. You've got zero COVID policies in China. You've got Europe with restrictions. You've got the UK and the US who simply want to go through it, hoping that we will learn to live with it. And somehow we've got to get to uniformity.
Joining us now, Stuart Kaiser, Victoria Green, Michael Kushner. Victoria, I want to come to you on the EM side of this. China, Hong Kong, others dealing with this radically different to, say, compared to the UK, the United States. Does that shape your view at all on how you allocate capital beyond America?
Yeah, it's more so I'm looking at the dollar and some other areas and growth prospects more than COVID policies. But I think you're going to see, especially China, be extremely harsh leading up to the Olympics. I think China's going to be very quiet on any economic moves or any controversial moves, and they're going to have everything clamped down because they want the Olympics to go off without a hitch. So I think you're going to see very, very extreme measures coming out of Asia. I don't think you're going to see the US or the UK respond. I don't think there's the willpower of their population, honestly, to have them respond with any lockdowns, with any mandates. We'll see what the Supreme Court says about the OSHA rules. But honestly, the temperature here in the United States, it would be very, very difficult to go back into lockdowns. Now, we're seeing some shutdowns happen naturally only because we're seeing this virus spread so quickly. So any of the labor shortages, I think that's going to be a rough couple of weeks here. I think I read somewhere about 5 million people are anticipated to potentially miss work this week because of virus issues, but hopefully it's milder and quicker, and I think they'll learn to live with it. I don't think the U.S. is going to change that policy.
Stuart Kaiser, you said you liked the banks. We talked about that. In your notice says avoid EM. Why, Stu?
Well, I think one of our themes for next year, actually, Jonathan, is just growth dispersion. You know, because countries are coming out of this at different points of time, and they're dealing with lockdowns in different ways. You're going to have dispersion kind of, hit from a growth perspective, and the view here is certain areas, parts of Asia that we've already highlighted, potentially the Eurozone, India, are going to have, growth kind of lagging in the recovery because they're much more restrictive, whether it's zero tolerance or close to it, to the COVID issues. You also have obviously the moves in yields, which are pretty punishing for EM equities as well. So I think it's a combination of how we see the sequence of growth and the restrictions dragging on growth, as well as, kind of the macro impact from higher yields and the dollar.
Michael, what's the relationship there between what's happening in the Treasury market at the moment and the global economic backdrop?
It's an interesting dynamic because the Fed with U.S. inflation situations turned out to be much worse than almost any other developed industrial country in the world. And the Fed and the U.S. Treasury government has been running the easiest combined monetary fiscal policy, injecting the most amount of support into the economy. So the U.S. economy has boomed and been the exceptional performer, as it's been for a number of years since the global financial crisis, boosting the equity market, et cetera, and keeping yields down as capital flows into the country as well. So I think the fact that the U.S. is learning to live with it, or wants to learn to live with it faster than other countries want to learn to live with it outside of, say, the UK, suggests that the U.S. economy is going to do better if these other countries resort to more aggressive measures, which in my mind is not yet clear how that is going to proceed. But on the other hand, it does look like the U.S. is going to have the tightest monetary and fiscal policy in 2022 as well, restricting growth and tightening policies at the margin relative to where they were. So that dynamic is going to be quite interesting. I could easily see U.S. growth being a laggard in 2022 as a whole relative to Europe or Asia.
But we have the tighter monetary policy. And Victoria, that raises a question for me. Is it our monetary policy your problem? Are we playing that game again, or is it somewhat different?
I think what we do obviously is going to affect everybody globally, and so as we become more hawkish and we maybe are tightening, we're gonna see the world respond. I mean, the people kind of started coming in to buy the bonds at 1.8. Suddenly, we're the attractive yield again, and so whatever we do, it's not we sneeze and the world catches a cold. But if we do tighten, I think you're going to see opportunities. You might see foreign buyers come in as the Fed steps out. You may have foreign buyers wanting to buy the Treasury markets more, but we're not the first to tighten. If you look around, I know a lot of the other major economies, especially emerging markets, are looking a little looser, but I think you could see tightening happen across. I think the UK came out, and so we're not the only ones looking to tighten. I think a lot of developed economies are going to look to tighten. We may be doing it a little bit faster, but I don't think it's going to change necessarily how the world reacts. I think everybody's trying to get their economy back on point and fight this two-headed monster of the virus on one hand and inflation on the other. And so everybody has the same set of tools. So what we're doing, I think, is no different than any other developed nation's going to do. But German bonds still haven't been able to get above zero. And when they're that low and we're suddenly 1.8 on the 10-year, we're attractive again.
They're getting closer and closer. Victoria Green, Marco Kushma, Stuart Kaiser sticking with us. Coming up, the morning calls, and later, the great rotation staging a comeback as big tech grapples with rising rates. The Nasdaq has been hammered year to date, and we've only had a week of price action. From New York, this is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
How many times have I said this in 2022 already? What a start to the year. Bitcoin sub 40K, 10-year yields just sub 180, breaching that level a little bit earlier. And once again, the NASDAQ 100 down 1.4%, adding to the losses of last week. That's the price action. Let's get you some morning calls. We begin first up with Bank of America hitting higher with a double upgrade to buy from underperform with a 110 price target, saying the company is well positioned to handle rising inflation. Deutsche Bank upgrading Viacom CBS to a buy, the analyst citing potential sector consolidation and the company's streaming success. And finally, HSBC downgrading Nike to hold from buy, pointing to lingering supply chain concerns in the wake of the pandemic. Coming up, earnings season around the corner with the big banks set to report. JP Morgan this Friday.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Week 2 of 22 begins right now. Your equity market shaping up as follows going into the opening bell. Futures down 33 on the S&P. We're down 0.7%. It's been tough out there for the Nasdaq 100, down another 1.3% after a loss of 4.5% last week. That's the opening bell. Switch up the board and get to the bond market. The epicenter for some of the price action is right here, just sub 180 on 10s at 179.75. Yields up 3 or 4 basis points, breaching 180 a little bit earlier in the session. Yields higher for 7 straight days. Yields higher last week by 25 basis points on 10s. Euro dollar sub 113, 112.91, down 0.6%. Some dollar strength out there. Crude just below 79 at 78.90, unchanged on the day. That's the cross-asset price action as we open up here stateside on the S&P. We're down 0.7%. Top of the pile again, the financials up 1/3%. Discretionary, information technology, bottom of the pile. We keep talking about taking cues off the bond market. Yields higher on 10s by 4 basis points, on 2s by 2 or 3, up to about 90 basis points on a 2-year now, just south of that at 89. I want to bring back in Stuart Kaiser, Victoria Green and Michael Kushma. Victoria Green, I want to help me understand the difference between risk aversion and rotation, how big the line is between rotation and risk aversion when we're taking our cues off this bond market.
Certainly. I think you've seen this happen multiple times before. Last year's a great example. Every time the yields here spiked, the NASDAQ dropped. And so you have to look at some of these correlations and realize some of the growth at any price stocks, some of these high flyers or low revenues and high multiple stocks are really coming back down to earth. And people need to be looking and maybe less throwing at a dartboard and being a little bit more picky about where they are in this market. Financials, energy, industrials, materials, those stocks tend to do quite well in a rising rate environment, and they've done quite well as we've seen to start this year. And so the value trade, which started last year strong and then petered off a little bit, we think actually has some legs to stick this year. And so we want to look around this market and instead of, and understand what we own. I think too many people say, oh, the S&P 500, that's a broad-based index, but it's so cap-weighted to tech. Honestly, it tracks the Russell 1000 growth extremely closely. So you need to understand that's a little bit growthier, and you might need to be looking a little bit deeper at finding pockets where you want to be. And so we don't think it's the end all be all to the end of the markets. We think you want to be in value. We think you want to be in large cap. You may start looking small just because it has some attractive valuations down there, but it's very much going to matter what you own and where you are going forward. And we think energy and financials are a great place to be.
Well, that's what's been winning right now on my screen. It was winning last week in a big way as well. Stuart Kaiser, another way to ask the same question. When does the rate story become a problem for all of the market and not just pockets of the market?
Well, I mean, I imagine it has to do with obviously the absolute level, but also the pace with which you get there. I mean, I think that's what's really been disruptive the last kind of week or two is just the sharpness, of the move higher. What the ultimate break point is, I think that's, pretty difficult to determine. But I think there's a couple things at play here. It's the speed of the move and it's the flattening versus the steepening. Typically speaking, tech has actually done okay when the curve flattened last year, even if it was moving higher. Tech really lagged when the curve was kind of steepening out. So I think you kind of have a lot of moving parts here. But I think, from my perspective, our perspective, the catch up you've seen in rates has just been so rapid that's what's thrown people off balance. I mean, our house forecast was 180 for the 10-year for year end, 2021. We've basically just sort of caught up to that very quickly. Yeah. And now, on a go-forward basis, the question is, I think, the market wants to be comfortable that, well, the Fed's gotten hawkish, the market's priced that already, so now we can kind of move on. But the challenge is if inflation keeps coming in for the next 3, 4, 5 months at the rate we expect, then the degree of hawkishness priced in is going to have to increase. And I think, that's really going to be the challenge over the next few months is does the market need to price a more hawkish Fed and at what speed does it do that? Well, it's a challenge right now. The Nasdaq down another 1.6%. Losses last week mounting up to 4.5% there and thereabouts. On the S&P 500 down 0.9%. Breaking down the S&P at the moment. Financials, energy top of the pile. Consumer discretionary, information technology bottom of the pile. Into the bond market with 10s up 4 basis points back through 180. Michael Kushma, often in the bond market we think about how self-limiting a sell-off might be. Can you help me through that one right now? Work through it with me. 10s at 180. When does this start to become self-limiting?
Well, part of the self-limiting is what we discussed earlier about the global context. You know, how high do U.S. yields go relative to the rest of the world? How attractive does the U.S. bond market look relative to the rest of the world? With China slowing down and demand for lending or unwillingness to lend in China, China may maybe be subject to a excess savings problem. That money might leak abroad, either through official channels or through private sector channels. So the world being awash with liquidity is still true, even as the Fed tries to rein it in. So I think what really matters is, you know, through the sell-off we've had before and the rise in yields, we're only getting back to kind of where we were last year. And the terminal rate, the rate at which the people think the Fed will stop, hasn't changed all that much. It's still below 2%, which is really, really low. It's lower than it was at the end of the last cycle, even though inflation today has a lot more momentum than it ever has in decades. So the question is, if the terminal rate, the final rate the Fed needs to move rates to, moves higher, meaning the Fed hawkishness is not just about moving rates sooner rather than later, but the cumulative amount in 23 and 24 even keeps going up, then we can see yields rising even higher, 2.25%, 2.5%, if we're talking about, a 3% Fed funds rate before this comes to an end. But right now, I think it's a bit premature to price that in, but I have been impressed by the market's willingness to continue to hold on to this idea that we will stay below what the Fed says is a 2.5% terminal rate on the Fed funds rate.
So far, at least. Listening to Bill Dudley, though, maybe that conversation changes and changes quickly. Luca Paolini had this to say about the rotation, expecting it to drag out. He says the following: it's not a one-day rotation. This is the beginning of a potentially 6 to 12-month rotation from growth into value. The market has made a reassessment of the risk of monetary tightening, and I think the market now is right. For more on this, here's Abby.
Hey, John. Well, we're just 6 days into 2022 on a trading basis, and it's extraordinary, these moves that we're seeing on the rotation into the cyclical sectors and out of tech and growth. Take a look at energy and the banks this year so far, both up more than 7%. Last week, the best week since November of 2020. That was on vaccine optimism and the presidential election. That's the kind of buying we're seeing. On the other hand, tech and the chips both down more than 7%. For tech overall, the worst week since October of 2020, ahead of that presidential election. That's the kind of selling we're seeing. And if we break it down further, we're going to see it's all about Microsoft, Apple, NVIDIA, Google, plus Adobe, those high flyers, those high quality stocks of both 2020 and 2021, not starting out 2022 so well. And of course, the culprit, this chart is extraordinary to me. It is a 6-day chart of the 10-year yield backing up nearly 30 basis points in that very short period of time at levels last seen in January of 2020. This may be a gross exaggeration, but from a bond standpoint, it's almost as though the pandemic did not happen. It's really amazing what we're seeing relative to expectations around the Fed, the tightening, and what it is doing to sector composition right now, John.
We have filled that gap, and we've done it pretty quickly after a week. A move of 25 basis points on 10s last week. This morning, up another 3 or 4, up 4 right now to just below, just beneath, just south of 180. On my screen right now, 11 broad industry groups, only one is in positive territory. It's the financials, up 0.2%. The broader index down 1%. The banks kicking off earnings this week. JP Morgan in focus. Here's Kaylee Lines for more. Hey, Kaylee.
Hey, John. Well, JP Morgan as well as Wells Fargo will be first out the gate come Friday morning around 7 a.m. Eastern time. You'll also get Citi on Friday, and then Goldman, Morgan Stanley, Bank of America, all will be coming throughout the following week. Big focus point this quarter is going to be on investment banking. What do those advisory fees look like amid a global boom in M&A? JP Morgan last month said that it expects fees to be up 35% in the fourth quarter, though trading is expected to be down 10%. Declines there likely to be seen across the banks as the pandemic-era volatility starts to subside. We'll also keep an eye on loan growth as well as net interest income and the outlook around that in a higher rate environment. Put it all together, and the banks collectively are expected to pull in about $30 billion in income in the fourth quarter. JP Morgan leading that with an estimate near $9 billion. Bank of America at 6.4. Citi, Morgan Stanley, Goldman Sachs, Wells Fargo, all in the $3 to $4 billion ballpark. And looking at the financial sector as a whole, fourth quarter profits are expected to grow more than 11%, which ranks it third among the sectors in the S&P 500. Tech and healthcare, of course, both expected to see earnings up by more than a quarter, and the S&P 500 in its entirety is expected to see EPS growth of about 19.8%. That would be the fourth consecutive quarter of double-digit earnings growth, John, even if it is a decline from the 37% growth we saw in the third quarter.
Kaylee Lines, thank you. Kaylee, thank you very much. Victoria, I want to come to you. You said a little bit earlier on, I hope we can focus on the earnings Something like that anyway. I want to build on that just a little bit more. Just get away from the Fed chat, focus on the earnings starting this Friday with JP Morgan. What's the playbook for you going into earnings season, Victoria? What are you looking for?
Well, first off, we're looking a lot at forecasts. You know, I'd love to know what they think going forward, what their plans are, and if they can continue to do margin growth. I think, honestly, financials are going to come in strong. You've got consumers with great, healthy balance sheets. Rising rates are great for their internal margins. The one thing I am going to watch is the slowdown in mortgage applications. You saw Rocket Mortgage kind of struggle with that a little bit, that maybe this great refinancing boom as rates are coming up, you may see a little bit less on the mortgage side. But I think the banks are going to come in strong, and I'm very much looking also into their forward guidance. I think one of the reasons we're also wary of tech is you kind of talked about, okay, we're at the fourth consecutive quarter of double-digit EPS growth, but the problem is if growth is slowing a little bit, tech companies get punished mercilessly, even if they beat, but they have a bad forward-looking outlook, or if they beat, but they beat by maybe a little bit less than anticipated, or their growth is slowing a little bit, even if they're still growing at a great pace, their pace of growth is slowing. I think you're going to see some potential punishment in there. We remain buyers of dips. I think there's a lot of capital still on the sidelines. We're looking at opportunities to continue to put capital to work at good valuations. So I think you may see some headline misses, but I think financials and energy, honestly, are going to be strong. I'm a little wary what tech's going to do. Tech last time, the big names really struggled. You remember Amazon when they reported? I mean, even though they reported record profits, they got absolutely pummeled for warning on their forward guidance.
Stuart Kaiser, same question to you.
Yeah, I mean, I think, I think Victoria makes a lot of great points. If you look at the pattern last year of earnings, it was generally, consensus was too low going into the season. You got a pretty substantial beat of consensus, yet consensus refused to take up kind of the forward quarters. And I think we're kind of in the same situation here where the number kind of looks a little bit too low. We'll probably get a beat. And then the question is, what do you think, to Victoria's point, of the forward outlook? So, what are banks telling you about the pipeline? What are tech companies telling you about forward earnings guidance? From our perspective, I think we probably like being long tech into earnings or long the market into earnings. We do think you're going to get a pretty big beat of consensus, and that should stabilize that. A lot of what we saw last year was similar to that. The high quality, large cap tech, they, generally speaking, obviously there were some blips, but generally speaking, did pretty well during earnings because it was a reminder that these are just, free cash flow generating monsters that are generating a lot of earnings growth. So, our view is generally that earnings should probably skew positive to the market. And to Victoria's point, it's the outlook that's going to matter. And we'll see what happens there. We're looking at the NASDAQ VIX relative to the S&P VIX to get a sense for how much risk premium is priced into tech. And that spread's fairly wide right now. And hopefully tech, earnings help close that down a little bit.
Michael Kushman, that's the earnings story. Let's talk about the data finally. CPI Wednesday, retail sales Friday, a sneak peek of Wednesday, year over year could have a 7 handle. Is that what you're looking for too?
I think so. I think we're going to be 7% handle. We may have a 7% handle for a month or two before we finally peak. And the data, again, the global indications as well as the U.S. indications that inflation is much more persistent on not just persistent at the levels, but the rate of change up. And it's been difficult to forecast any kind of moderation in that number. So I think it's going to continue to drift higher for this month and next month.
Michael Kushman, thank you. To Victoria Green, to Stuart Kaiser, thank you very much. To all three of you, going through the opening bell, a choppy session again. We're down by more than 1% on the S&P. On the NASDAQ, we're down by 1.73%. Last week, we're down 4.5%. You add to those losses and throw in some geopolitical tension. Coming up, Russia looking to address NATO's eastern expansion as tensions run high.
What we are hoping for is that we can agree on a way forward, that we can agree on a series of meetings, that we can agree on the process.
That conversation up next.
many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I don't think we'll see any agreements between the US and Russia, which is the talk that will happen first. And it's unlikely we'll see anything substantial in the subsequent talk. So that's between Russia and NATO, respectively, and then within the OSCE, which also involves Russia and Ukraine. But I think the most substantial effect or outcome is easy to predict, which is that Russia will emerge victorious.
The US and Russia coming to the table amid rising tensions over Ukraine. This coming as President Biden steps up the rhetoric against the Kremlin, with the administration weighing tech curbs. For more on this from DC, our Washington correspondent, Bloomberg's Anne-Marie. Hey, Anne-Marie.
Good morning, John. Well, as we have a slate of meetings this week between the United States, Russia, NATO, and European allies, the key question really for President Putin becomes whether or not he wants to make that play on Ukraine, and that would mean some very harsh restrictions in terms of sanctions and trade exports from the United States. And what we're hearing is they could be as strict as what we've seen in the past with the United States and countries like Iran or Syria or North Korea. So some of them would be a curb on sensitive technology and electronics. John, that can range from anything from aircraft, military tools, and that kind of technology to gaming consoles and smartphones. Also curbing the exports from the United States to Russia and potentially even microelectronic chips or software that comes from the United States. Then, John, of course, there's all that mulling, which for years has always been something the U.S. kind of waved and teased with, potentially sanctions when it comes to the SWIFT payment system. Now, that would spark havoc throughout the Russian business and corporate elite, as well as potentially some other global companies as well. So eyes are really on the sanctions. But going into these talks, we heard from Secretary Blinken. He said, don't expect a lot. At the moment, they are talks. The atmosphere right now can just be for talking. It's especially difficult, as he says, when Putin has a gun to Ukraine's head.
Anne-Marie, wonderful, as always. AMH, with all her experience across Russia and beyond, down in Washington, D.C. Anne-Marie, thank you. If you're looking at the energy market right now, you've got to navigate that, easing supply disruptions, throw in a demand revival. This is what RBC's got to say on prices. With improving demand, tightening inventories, and questions of OPEC's ability to ramp further, the directional arrows of progress point to further optimism. To put it all together, Bloomberg's Julian Lee. Morning, Julian.
Morning.
run me through your expectations for OPEC Plus now, staring down a crude market with Brent at 81.
Yeah, I mean, they've agreed to add production, more production at the start of February. They're going to add another 400,000 barrels a day. That's in line with their strategy that they outlined back in July last year. The problem is that because so many of the members of the group now are running up against capacity constraints, the actual increases that we're getting month on month aren't anywhere like 400,000 barrels a day. They're probably closer to 260, maybe 300,000 barrels a day. And so they're constantly falling behind what they say they're going to do. For November, the last month for which we have production data from OPEC itself, collectively, they were underproducing against their target by more than 600,000 barrels a day.
Julian Lee on the crude market. Julian, thank you. Just want to jump back to this equity market beyond crude. Crude right now down about 0.5% on WTI to 78.50, on Brent 81.34, down 0.5% as well. But look at the broader market. Where are we? 20 minutes in, we're down 1.27% on the S&P 500. On the Nasdaq, we're down by 1.65%. Big losses last week. No bounce back whatsoever this morning with the sector price action. Here's Kriti Gupta.
Yeah, well, good morning, John. A lot of red on the screen, a lot of that tech kind of lagging, a lot of the tech weighing on the index broadly. That's really what you're seeing. I want to really quickly mention what's actually not doing that badly. Of course, you have all 11 sectors in the red, but financials are actually at the top of the pack. And if you look underneath the hood, the banks in particular ahead of earnings season, of course, JP Morgan kicking off those earnings on Friday, you are seeing them rally in line with those yields. But really on a sector basis, tech is really where you're seeing a lot of the story. A lot of that selling being attributed to hedge fund positioning. But you're also seeing one intraday story, and this is, of course, going to be one of the major deal news. Take-Two, the fourth largest U.S. video game publisher, saying it's going to buy mobile game maker Zynga, the deal valued at $11 billion, making the creator of Red Dead Redemption kind of diving into mobile gaming at a time when this sector broadly has been under a lot of pressure from the China crackdown. Does this, however, recover some of those 2020 video game gains? That remains to be seen, John.
Kriti, thank you. Kriti Gupta on top of the sector price section. Most mornings at around this time. In the bond market, your 10-year yield up 3 basis points to just sub 180. Big conversation about the next moves of the Fed. Big conversation about Goldman Sachs' call of 4 interest rate hikes this year. The interesting part of that call for me was this line from Jan Hatzius. We no longer think that the start to runoff will substitute for a quarterly rate hike. It's the interplay between balance sheet reduction and rate hikes that gets fascinating from here. And what actually balance sheet reduction equals in terms of, say, rate hikes. This came from Matt Lazzetti over at Deutsche Bank. We expect liftoff in March, 4 hikes in 22, QT to start this summer. Seems to be base case right now for a lot of banks. Our preliminary calculations suggest that while runoff would be 300 to 400 billion in the second half of this year, it would be around 1 trillion in 23, equal to roughly 2 hikes in total. So this is what we've got to work through together through the next couple of months with the Federal Reserve and for a lot of economists on Wall Street. What are they looking for in terms of balance sheet reduction? Does it replace or complement their calls on rate hikes? And right now, it's 4 hikes and balance sheet reduction that is quickly becoming the consensus view on Wall Street for the likes of Deutsche Bank, Citi, JP Morgan, and others. Coming up, the market moving event you need to be watching. That'll be next in our trading diary from New York City this morning. Good morning to you all. Your equity market's lower on the S&P and much lower on the Nasdaq. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
"26 minutes into this, it's not the bounce you might have been looking for on the Nasdaq 100. Last year up 27%, down 2% this morning, and down about 6% on the year so far. Very early into the year too. On the S&P 500 down by 1.43%. A lot of this is coming from the bond market. Switch up the board and get to say tens on the year. And we've not had much of 2022, up almost 30 basis points from 150-ish to 180-ish, up 4 basis points on a day, 180.11 on a 10-year yield. That's the price action. It's brutal. Here's the trading diary for you. U.S. wholesale inventories at the top of the hour. The Senate Banking Committee holding a hearing on Fed Chair Jay Powell's renomination on Tuesday. Fed speak coming up. Mester George Bullard all on deck. U.S. CPI on Wednesday. Another round of claims on Thursday. And finally, rounding out the week with retail sales on Friday and some JP Morgan earnings in the mix too. Is that enough for you? From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.